To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Before we start this session, let me put a couple of things into perspective. Accounting standards carry about 30 to 35 marks in your exams. And if you crack this accounting standards related question, let me tell you, getting those passing marks or getting 50 or 60 will be much easier if you are able to crack the accounting standards related questions in the examinations properly. So let me share with you a kind of an analysis. I'll just share my screen. Now, this is just an analysis of all the attempts of the new syllabus, right, from May 18 till July 21. And if you look at the accounting standards related questions, you can see that in every attempt, right, in every attempt, you can see you have 5 plus 5, 10 here and another 15 here, around 25 marks here. 15, 20 marks here, 20 marks here, 25 marks here. So every attempt on an average, you will see that you would be getting about 25 to 30 marks of accounting standards related question. And also, it is important to note that accounting standard 3 is a separate chapter, and sometimes you get 10 to 12 marks of question on that. And we have this chapter on investment, which is based on accounting standard 13. Even here, you get around 10 to 15 marks. So you can see this 15 marks, 10 marks, 10 marks here. And from cash flow, 20, 12, 15, 10, 10. So all in all, if you are comfortable with these standards, that is right from accounting standard 1, whatever is a part of your syllabus, right? 1, 2, 3, 4 and 5 are a part of your group 2 now. Earlier, they were part of group 1. Then 10, 11, 12, 13, 16. So if you are comfortable with these standards, you can easily score 20 to 25 marks. And let me tell you, my experience has been that the questions which are asked in accounting standards are not very difficult. Once in a while, they may be difficult, but generally they are not very difficult. So you should be in a position to solve them easily. So what I'll do is I'll share the screen where I've prepared, brief summary notes which can help you to revise, and then we'll take up standard by standard, right? So this document contains crux of all the standards that we would be discussing. This is not an in-depth document, but if you cover these areas, let me tell you, you would be easily in a position to cover 80 to 85 marks, 80 to 85% of the accounting standards in the examination. And questions are generally of, a pattern. There is a pattern in the questions which are asked in the examination. You will not get any kind of unique questions. Once in a while, they may give you some unique questions, but otherwise, definitely no unique questions. Most of the questions would be repetitive in nature. Once your concepts are clear, it will be easy for you to address those questions in the examination. So to begin with, the first standard, accounting standard 1, the easiest of all, and I'm sure most of you would be, would not be even reading this standard, but that would be a mistake because sometimes a 4 to 5 marks question may come from this, and there you need to write in theory. Okay, so this is a standard where there is theory. And if you forget the theory, you will not score marks. So just because it's a simple standard, don't ignore this standard. This also has a good amount of chance of appearing in the examination. Okay. So the first one, accounting standard 1, where we talk about disclosures of accounting policies. Right. So what are accounting policies? Accounting policies are specific accounting principles and methods of applying those principles adopted by the enterprise in preparation and presentation of financial statements. So this is the definition. So what are these? These are accounting principles. Now it could be in relation to, let us say, inventory. It could be in relation to property, plant and equipment. It could be in relation to some intangible asset. Specific accounting principles, and how are you applying those principles while preparing financial statement? This is what is an accounting policy. Now, one question which can come from this particular standard is, what has to be the disclosure whenever there is a change in accounting policy, right? So if at all there are changes in accounting policy, what should be disclosed? And please note, when should we change the accounting policy is covered by AS 5, which tells that if it is required by a statute, if it is required for better presentation, or if it is required by some other accounting standard, then you can change the accounting policy. But otherwise, you will need to be consistent in applying the accounting policies. So 3 fundamental accounting assumptions: going concern, consistency, and accrual. These must be followed, right? So if you are not consistent in applying accounting policy, if there are changes in accounting policies, then in that case, you have to disclose. What is to be disclosed? Disclose the change which has material effect in the current period or is reasonably expected to have material impact in later periods. So those changes which is likely to have, one, material effect when in the current period or is expected to have a material impact in future periods. So these changes have to be disclosed. Second, if the change has material effect in the current period, to the extent ascertainable, what is the amount by which any item in the financial statement is affected by such change? So, whenever you are changing an accounting policy, if it has impacted materially some item in the financial statement, you have to disclose the amount by which that item in the financial statement is affected. If that amount cannot be determined, then you have to indicate the fact that we cannot determine that particular amount, right? This is very important as far as a theory question is concerned. They may ask you a question wherein they would ask whether accounting policies can be changed. Can the company change the accounting policy? If yes, what has to be disclosed? When can they change? And all of those things. Now, two quick things. While selecting accounting policies, certain considerations have to be taken care of, which are that the financial statement should represent a true and fair view, and you have to follow prudence, substance over form, and materiality. Now, this materiality related concept you would come across at multiple standards. In auditing, you would be referring to this concept again and again. Also, substance over form, if you look at things like accounting standard 19, which talks about substance over form, right? And prudence is more of your conservatism concept. You do not recognize gains, but you do not recognize gains which are not realized, but you recognize any possible losses, right? So these are the considerations for selecting an accounting policy. And obviously sometimes a short note on the three fundamental accounting assumptions. Please note, even if it is a 2-mark question, that will add up to your total. So don't ignore this particular standard. Going concern, consistency, and accrual. What is the meaning of going concern? It is assumed that an entity will continue to operate in the foreseeable future and it neither has the intention nor the necessity to cut down its operations. That is the aspect related to going concern. Consistencies, the conventions, the principles, the policies have been applied consistency on a year-to-year basis. And if there is any change, it has to be disclosed. And lastly, you need to follow accrual concept where income and expenses are accounted for on accrual basis, but not on cash basis. If these three are followed, then there is no disclosure required. But if these three are not followed, then you will have to disclose if going concern or consistency or accrual concepts are not followed in the preparation of financial statement. This is the crux of AS1. I've kept it brief because once you understand these aspects, the essence of the standard is covered and you will be able to attend most of the questions from if you are thorough with these kind of topics, right? Accounting standard 2. This is one standard where almost in every attempt you will get a question. Almost in every attempt. So if I have to refer back to my sheet, AS2 except in November 20 and November 18 you have got in May 19, November 19, Jan 21, July 21. Mostly you will get a question, and that question is specifically for valuation of inventories. And I have seen students during the course of my evaluation, they make silly mistakes and lose marks. It is not that you don't know the concept. You know the concepts thoroughly. Some silly mistake here, some silly mistake there. That is what cost marks to the students. So here if time permits, towards the end of the session, I'll definitely be taking up a couple of questions from the past examination where I can highlight the kind of mistakes that the students generally make. Okay, so let's get on to AS2, accounting standard on inventory. Inventories are, what are inventories? These are assets, right? So assets means you will get future economic benefits from these resources. They are held for sale in the ordinary course of business. Now, the first aspect covers those assets which are held for sale in the ordinary course of business. Now, what do I mean by that? If you are holding an asset for use in the business, let us say you purchase computers and you're using those computers in the business, you will cover them under AS10, property, plant and equipment. But if you are purchasing computers to sell them in the ordinary course of business, this is very important. You can also sell fixed assets. It's not that you cannot sell fixed assets. Fixed assets also can be sold. But if you're selling them in the ordinary course of business, if that is your core part of operations, then those items or those assets can be classified as inventory. This one covers finished goods. Sorry for the handwriting because I'm using the cursor. Otherwise, I'll type it out. Then they are in the process of production for such sale, basically your work in progress, and they are in the form of materials or supplies to be consumed in the production process or in the rendering of services. Okay, so three items covered: finished goods, work in process, materials, and supplies. There could be, this could be lubricant oils, this could be some small spare parts which are used in the production. Okay, and they do not cover spare parts which are covered by accounting standard 10 PPE. Now what do I mean by that? If any spare part is recognized as a property, plant and equipment as per accounting standard 10, then those parts will not be covered by AS2. But if any spare part is not recognized under AS10 because it does not meet the recognition criteria, that will be covered under AS2. Now let me ask you one question, and I want you guys to answer. What is the principle for valuing raw materials? As per accounting standard 2, I know all of you would have already completed this a couple of times. What is the principle to value or to measure raw materials? Can you guys answer? I'm just waiting for the answers out here. See, you have 5 plus 5, 10 here, and then okay, one answer is I got. Is it cost? Is it lower of cost and net realizable value, or is it only cost on the basis of valuation of finished goods? Cost or replacement cost? Okay, so this was cost or market price, whichever is lower. Sorry, that is not the right answer. Cost or market price. No. I am asking about raw materials. The reason why I gave you this question, or why I asked this question in this session, is this is one aspect which is most likely to be tested in the inventory related question as to valuation of inventory. Now there are two things, guys. One, generally inventories are valued at lower of cost and net realizable value. This is the principle we know. What students do in the exam is, even if the question asks about raw material, they will apply this principle, lower of cost or net realizable value. We should not be doing that. As far as raw materials are concerned, raw materials are valued at cost. Always remember this principle. Raw materials are valued at cost unless finished goods in which they will be incorporated are expected to be sold below cost. And please pick up any examination question. You will see that at least 50 to 60% of the times this concept is tested in the examination. And this is where students tend to make mistakes. Here also we saw some of them could not answer it correctly. It's okay. We are revising so that we don't make the mistakes in the examination. Lower of cost or NRV is for finished goods only. Lower of cost and NRV is for finished goods only. For raw materials, the general principle is that they will be valued at cost unless the finished goods in which they will be incorporated are expected to be sold below cost. So if finished goods will be sold below their cost, then you will apply the principle of lower of cost, or you will apply the principle of lower of cost or NRV. But generally you will take up this NRV in that case. And what represents that NRV for raw materials? Replacement cost. It represents replacement cost. So you will bring it down below cost, and you may value them at replacement cost only if finished goods are expected to be sold below cost. Please don't forget this concept. Okay. Then what is NRV? NRV is nothing but estimated selling price. That is the price at which you will sell the product, less estimated cost of completion and estimated cost necessary to make the sale. Okay, so let me just open an Excel so that I can okay, I hope the Excel is visible. So you have to take the selling price less cost to complete less cost to sell. This is what gives you net realizable value. Okay, now let us apply one a principle for the raw material and finished goods part. Okay, let us say there is a raw material. The cost of the raw material is 40, for example. Okay, there is a finished product. This finished goods require 1 unit of raw material. Let us say this is 1 unit cost. This requires 1 unit of raw material. So raw material is 40. Okay. Then it requires labor of, let us say, 20. There are other conversion costs like your overheads and all, whatever have been allocated. Let us say that is 10. So the cost comes to 40 plus 20 plus 10, 70. Okay. And the realizable value, the NRV, selling price less, cost of completion to, selling price less cost of completion, cost to sell, etc. all put together, NRV comes to 80. Now in this case, you will check lower of cost and NRV. Lower of cost and NRV is 70. So you will value the finished goods at cost, which is 70. Okay. And raw material will continue to value at 40. What if this NRV is 60? If NRV is 60, you will value the finished goods at 60, and for raw material, you will check what is the cost and what is the replacement cost. What is the replacement cost? If the replacement cost is 35, you will bring it down to 35. If replacement cost is 45, then you will continue to value it at 40. Now, just don't make a blanket assumption that if the raw material, if the finished goods are sold below cost, we'll always value at replacement cost. No, you'll value either at lower of cost or replacement cost, right? This information will be given to you in the examination. Please ensure you do that properly. Okay, then the assessment of NRV has to be made at each balance sheet date. This can be a theory question if at all they ask. Then coming to the next aspect as to what do we mean by cost of inventories. When we say lower of cost and NRV, what do we mean by cost of inventory? And this concept that you learn will also be mostly applicable when you do property, plant and equipment as per AS 10. Okay, so cost of inventory will have cost of purchase, cost of conversion, other costs incurred in bringing the inventories to their present condition and location. Okay, so please remember this one. Whatever costs are being incurred to bring the inventories to their present condition and location, your purchase cost, cost of conversion, other cost, all of that put together is considered to be cost of inventories. What does cost of purchase include? Your purchase price less trade discounts, rebates, etc. Cash discount is not adjusted. Then duties and taxes other than refundable duties and taxes. So what is refundable duties and taxes? If you have paid GST on which input credit is available, you will not consider that. But if you have paid, let's say, custom duty, or if you have paid some other tax on which refund is not available, on which credit cannot be claimed, then that will be excluded. That will be included. Freight inwards, that is your transportation cost, insurance cost, all of that, and any other expenditure attributable to the acquisition, that is purchase. So whatever is the cost that is incurred, that will be totaled up and you will arrive at this cost of purchase. First aspect. So we have done with cost of purchase. Then cost of conversion. Allocation of fixed production overheads based on normal capacity. Please note, sometimes the production may be less. Sometimes the production may be less. Even then, you will use the normal capacity to allocate the production overhead. So your formula will be estimated overhead divided by normal production. Okay, so by applying this formula, you will get a rate. That is the rate you will apply while calculating the cost of inventory. What if actual production is more? Here you will use actual production. So in case of normal production, if actual production is more than normal production, you will use the actual production to calculate this particular rate. Okay. Then you will also assign variable production overheads on the basis of actual use of production facilities. More of your costing related concepts. These again information will be directly given to you in the examination. Any more doubts? Okay, there is a question which says, what if selling price includes profit? Even if selling price includes profit, calculation of NRV is selling price minus cost to complete minus cost to sell. If replacement cost is not mentioned, see, if they are asking this kind of question in the examination, they will mention replacement cost. Otherwise, you will continue to value them at cost. They may give some indirect information. They may give some indirect information that this is the price at which you can purchase. So that will be the replacement cost. Then this is again, one of the favorite theory questions, if at all they ask, or they may include this as a part of calculation of cost. So you will always exclude abnormal wastages. So if there are normal wastage, you will include. If there are abnormal wastages, you will exclude. Then storage cost, unless necessary in the production process. So if storage costs are necessary in the production process, then you will include, otherwise you will not include. Generally it could be a case where you store, let us say, a product like wine. The more you store, the more value it gets. So, and because it is getting more value because of storage, you may include the storage cost. Otherwise you will not include the storage cost. Selling and distribution cost, never, because those are related to sales. Administrative overheads also you will exclude, unless those are incurred to bring the inventory to their present condition location, very less chances, and any other unallocated overheads, right? So these are what is excluded, these are what is included. Okay. Then the standard prescribes cost formulas, it can be specific identification method if you can specifically identify the cost of inventory, or generally we use FIFO or weighted average. LIFO is not allowed as per accounting standard 2. Most likely from this standard, the question would be based on this principle of lower of cost and net realizable value, and the exception to that. Also, what is to be included in the cost, what is not to be included in the cost. There is a question, what is logic behind this? I didn't understand the question behind that, so you can repeat the question if you can. Then, can you explain replacement cost? So replacement cost means cost that you would incur today to replace the materials. For example, I have raw materials of 100 kgs with me. I have purchased them at 10 rupees per kg. Today, if I go to the market and if I want to purchase the same thing, it will cost me, let us say, 9 rupees, or it will cost me 11 rupees, whatever is the case. That cost to replace means cost to purchase it afresh is called replacement cost. So if you get materials free of cost, then there will not be any value attached to it. You may value it at nominal value, let us say 1 rupee kind of a thing. Because accounting standard 2 is, accounting standards per se, they do not follow fair value approach. Okay, fixed overhead recovery rate, let us say, we have something called fixed overhead recovery rate, or this is also called as ORR, overhead recovery rate, or sometimes they call it predetermined overhead recovery rate. So you have to take total fixed overhead, let us say it is 1 lakh. Okay, total overhead is 1 lakh. Normal production is, let us say, 40,000. So what you will do is cost per unit, fixed overhead recovery per unit will be 1 lakh divided by 40,000, 2.5. But let us say actual production is 50,000. Then your recovery rate will be 1 lakh divided by 50,000, which is 2. But if actual production is 30,000, then in that case you will not increase the fixed overhead recovery rate. You will take 1 lakh divided by 40,000. Okay. So if actual production is less than the normal production, you will use the normal fixed overhead recovery rate. Whereas if actual production is more than normal production, you will use the actual rate. Joint products and byproducts. So joint products are basically, a single, let's note it down here. So there are a set of raw materials which are put into a particular process, and then you get output. If you get more than output, let us say you get product A, product B, product C, petrol, diesel, LPG, kerosene, right? Where you process crude, refining is the process, and what do you get? Petrol, diesel, kerosene, LPG, etc. Right? So these products are called joint products. Why are they called joint products? Because they are consciously produced and each of them have significant value. Each of them have significant value. These are called joint products. Byproducts are incidental products like scrap. And while understanding joint product, please note that the place or the point from which these are split, you can independently identify each of these products, right? This particular point is called split of point. And all the cost incurred up to split of point are joint cost. All the cost incurred up to the split of point are called joint cost. These joint costs can be allocated on the basis of units or on the basis of estimated net realizable value at the split of point. If replacement cost is given, how to solve the question if replacement cost is given? If replacement cost is given, then you have to check whether finished goods are being sold at less than the cost. If finished goods are being sold at less than the cost, then you will value raw materials at replacement cost. So let me write it down here so that it is clear for you. Here, okay. So if replacement cost is given in the question, then it will be useful for raw material valuation and raw material valuation. So it cannot be more than cost anyways. So if finished goods are being sold at less than cost, then you will value raw material at replacement cost. I hope it is clear now. This review. Yeah, share of joint cost is generally calculated as per your costing principle. You can use units method. You can use the net realizable value method. So what is the logic behind using replacement cost when there is a loss? See, the idea behind bringing, so what is happening here? Come back to this example. My total cost of finished goods is 70 and my net realizable value is 60, meaning to say I will not be able to recover the full cost. So when I'm not able to recover the full cost, as a concept of prudence, should I not provide for the loss in the value of raw material if there is any loss in the value of raw material? So let us say this replacement cost is 35. My actual cost is 40. There is a loss in the value of raw material, correct? But generally what I expect is by using this raw material, I will be able to manufacture a finished product which I will be selling at a profit, So if I am selling these products at profit, then I'll continue to value raw material at cost. Otherwise, I'm making a provision for reduction in value of inventory. See, the moment I reduce the value of inventory, my profit will go down. I'm actually making a provision for that loss in the value of inventory. That is the reason why we are using, that is why we are using replacement cost. Now, another question which comes is why can't we use net realizable value? Why can't we use net realizable value? Simple reason is you don't sell your raw material directly in the market. Okay, you don't sell your raw material directly in the market. So you will not get anything called net realizable value. What the standard says is replacement cost is the best estimate of net realizable value in that case, right? So that is why we are using the replacement cost. Guys, if you are chatting with one another, I am simply removing from the chat list so that it is you don't disturb others. Byproduct can be treated in two ways. One, you can treat it as other income, or you can reduce it from the overall cost of the product. You can reduce that and then compute. There is a question: EIS and SM videos of new syllabus helpful to old syllabus? SM is 100% helpful. EIS will not be helpful. If overdraft has been specifically taken for financing current assets like inventory, can we include interest on bank overdraft into cost of finished goods? You need to check as per accounting standard 16 whether it is a qualifying asset. If it is a qualifying asset, you can include, otherwise you cannot include. Substance over form means you are trying to see the actual substance of the transaction, actual facts of the transaction, then just considering the legal form. For example, if you look at, accounting standard 19 on leases, for assets taken on lease, even the lessee shows the assets in the balance sheet, though they do not own that asset. So ownership is the legal form. Taking on lease and ensuring that all the benefits are flowing to you is the substance part of it. Okay. If cost and NRV are same, then obviously whether you take cost or NRV doesn't make a difference. It has to be lower of cost or NRV. If both are equal, you can take any of the product. Okay. So with this, it's a quick summary of AS2. We've finished it off. We'll move to accounting standard 3, which is to do with the cash flow statement. Okay. Cash flow statement, guys, you should not be losing marks if you get a question from cash flow statement, whether it is a theory question or whether it is a problem based question. I know there is a separate chapter on AS3, so I'll not be getting into depth of the problems, but for those of you who want to master the indirect method of solving the cash flow statement, which is, most of the students, they find it difficult. We already have a video on YouTube on indirect method. You can just search indirect method Indigo Learn. You will find that as far as AS3 is concerned. Here we'll build the conceptual knowledge and look at 2 or 3 critical adjustments where students make mistake. Okay, so the idea here is to help you understand where you can make mistakes in the examination, right? So coming to cash flow statement, definitions are pretty straightforward. Cash comprises cash on hand and demand deposits with bank. Demand deposit means you can go to the bank and you can demand from the bank anytime you want, like your balance in your savings account or current account. Those are demand deposits. Time deposits are given back to you after the expiry of time, like your fixed deposits. Okay, fixed deposit also you can withdraw it prematurely, but you cannot demand it. If the bank says, bank has rules that will not allow you to prematurely withdraw fixed deposits, then you may not be able to withdraw them. Or even if you withdraw, there will be some penalty which is involved in that, right? So this is cash. Cash equivalents are short-term, highly liquid investments that are readily convertible into known amounts of cash and which are subject to insignificant risk of changes in value. Meaning to say, these are almost equal to cash. These are just like cash. They are not cash. Short-term, highly liquid. Short-term means for a short period of time, generally 3 months. Highly liquid, you can realize it whenever you want, and the value should not change significantly. Those are called cash equivalents. So let us say you place a 3 months fixed deposit with bank, that can be considered a cash equivalent for the presentation of cash flow statements. Okay. Now, all of us would be knowing this. Cash flow has 3 heads: operating, investing, financing. But sometimes students get difficulty in classifying what is operating, what is investing, what is financing. I'll give a very simple technique which will cover 90 to 95% of your classification related problem. It will solve your 90 to 95% of classification related problem. Okay. So we have this P&L. Here you have sales, cost of goods sold, expenses, depreciation, interest, and let us say profit or loss. Okay, I assume there is a profit. Tax also. So let me add that. Then you have balance sheet. What do you have in balance sheet? Here you have non-current assets, right? Then you have investments, current assets. Then you have on the liability side what we call, you have outside liabilities, or you can say non-current liabilities, loans and borrowings that you have current liabilities, and you have equity. So let me add equity on the top. Okay, this is the structure of your P&L and balance sheet. Now, whenever we are preparing cash flow statement under the under direct method or indirect method, we need to identify what should go to operating, what should go to investing, what should go to financing. Okay. Almost all of these items, what you see in the P&L here, almost all the items that you see in the P&L here, most of these will fall into operating activities except things like interest. Where will interest go? Interest is in relation to raising of money, raising of funds, so it will go to financing activity. But your sales, basically operating means your core operations, what the entity does on a day-to-day basis. Sales, cost of goods sold, your items related to inventory, purchase of inventory, payment to suppliers, and all of those things. Other expenses, payment to employees, payment of wages, payment of administrative expenses, all of those things. These are part of your operating activities, and tax related to that is also a part of your operating activity. Okay. Now, as far as depreciation is concerned, this is not a cash flow related item. So that is why whenever you prepare a cash flow statement, to the net profit, you add back depreciation, because that is not a cash flow related item. There is no cash outflow. Okay. Then something to do with equity and loans. So if shareholders have given you money, or if you are giving money back to the shareholders, if lenders have given you money, or you are repaying those loans, or if you are paying interest on that, or if you are paying dividend to equity shareholders, something to do with equity and loans, which these are classified as financing activity. Okay, this is a part of your operating, this is a part of your financing activity. Something to do with non-current assets and investment, these are classified as your investing activities. Sir, then what about current liabilities and current assets? Current assets are linked to your sales, current liabilities are linked to your expenses, so these will be part of your operating activities. This gives a broad classification of items in the financial statements as far as cash flow are concerned. Okay, so what is cash flow from operating? Those which are principal revenue producing activities and other activities that are not investing or financing activities. So if something does not fall in the investing or financing activities, that also falls under operating activity. What is investing? You are acquiring long-term assets and other investments. Now please note here, under current assets you have cash also, cash and cash equivalent. Now these are shown as a reconciliation item at the end. What was the beginning cash flow, what is the movement, and what is the ending cash flow, right? So these are investing, financing, that result in size and the composition of the owner's capital, and borrowing. So this is the broad classification. Two types of question can come in the examination. One, a numerical, where you have to actually solve it. Second, you are asked to classify. You are asked to classify. So if it is, let's say, dividend, which part would it fall into? If it is dividend, then where would it fall into? Guys, if you can answer, it would be slightly interesting for others also, and for you also to revise. So these are investing, financing, that result in size. Financing, okay. Finance, good. Interest received, okay. If you have received interest, then investing activity. Or also please note, there could be cases where giving money or lending money is a part of the business of the entity. Then it will be part of your operating activities. Okay, so interest paid will be financing, interest received will be investing. Please go back to last 2-3 years questions and see. And also there are a couple of questions in the study material also. There you try to figure out these kind of questions and try to classify them. Okay, dividend paid, financing, dividend received, investing. Very good, nice. Okay, so which is clear. Provision for example for cash equivalent, short term investment. Let us say you have purchased an instrument which has a maturity of just 2 months left. You purchased, let's say, a debenture, or you have put money into fixed deposit for just 2 months. That can be a part of your cash equivalents. Okay, now there are two methods, direct and indirect. Direct method is simply a summarization of your cash book. What are the receipts? What are the payments? Bucket them into proper heads. What you have received from the customers, what you have paid to the suppliers, what you have paid to the employees. That is a direct method. I'll focus on indirect method because, in fact, once I also forgot the format before the examinations. Okay, way back. So format meaning the order. Sometimes you get confused because of exam pressure and all of that. So it's absolutely fine. So cash flow from operations under indirect method, you generally start from net profit before tax. I'll come to the tax related adjustment. There will be a lot of confusion among students' mind. How to handle tax related adjustments, we'll come to that. Okay. Then if there are anything which are non-cash or which belong to other head. So when you prepare this P&L, this interest belongs to some other head. Depreciation is a non-cash item. So if there is any item of expense which is included, which should not have been included, you will add back. So if there is any item of expense which you have included, which should not have been included, you will add back. And if there are any item of income which should have been, a part of others, like for example, you have received interest and that is a part of investing activities, you will reduce. So please note, you will add back the expenses and non-cash items, you will reduce the incomes which belong to other head. That is one aspect. Then sometimes what happens is, there is a gain on sale of fixed asset. So gain on sale of fixed asset is not something pertaining to operations. So even that aspect you will reduce. So this will give you cash flow before working capital changes. Then comes working capital adjustments. Now, why do we do this working capital adjustment? I will not be teaching here. There is a video on YouTube already available. Please go through that if you want to understand the logic. I will tell you how to do because we are doing revision. We are not doing a full-fledged class. Now, working capital changes, what happens? Generally, you will be given, let us say, 2021 balance sheet and 2020 balance sheet. And please, in the examination, be careful while reading whether 2020 is given first or 2021 is given first. Okay. And let us say there are debtors. Okay. 1000 of debtors, and here it is 1100. Okay. Now, what should we do in the cash flow? Should we add or should we reduce? Should we add or should we reduce while preparing cash flow from operations? Let us see how many of them are, perfect in this. Add 100, add. Okay. So good. No, non-cash is different. Reduce 100, add 100, reduce 100, add. Okay. So what do we do? How do we ensure that we don't forget this treatment in the examination? See, just think of it that there were no sales. Think of it that there were no sales. We had to receive 1100 from debtors as on end of 31st March of 2020. Now we have to receive only as on the end of 31st March of 21, we have to receive only 1000. Meaning to say, we have actually collected 100 from the debtor. So there is a cash inflow, so you will add. So what you do is closing assets minus closing minus opening assets. Okay, you do this different, or opening minus closing assets. Okay, or I'll put it that will be more easier for us to understand. Opening minus closing for assets. What is opening? 1100 minus closing 1000. So 100 add. If debtors were 1200 minus 100. So you do opening minus closings for assets, and for liabilities you just do ulta, closing minus. Okay, whatever you do for asset, just you do the reverse thing for liabilities. I have explained this adjustment, the logic behind this in detail in one of the videos available on YouTube. So I am not repeating those in-depth explanation. I am just helping you remember this for the examination. Okay, that is the objective right now. Objective right now is not to do a PhD in cash flow. Objective right now is to not to forget this adjustment in the examination. And let me tell you, cash flow is something which you should not come back and say we could not tally. I know I have seen people who are qualified chartered accountants, and even they fail to tally cash flow. But once your logics are clear, once the methodology is clear, the cash flow will match. It is not possible that the cash flow will not match. Okay, so this is one adjustment for working capital changes. Then comes tax paid, and you have net cash from operating activities. Obviously, if there are extraordinary items, we will disclose them separately. We will show them separately. That is obviously understood, right? Now, tax paid also sometimes there is a confusion. So for which there are two approaches. So let us say provision for tax. This is one information that will be given 2021, 2020. Let us say provision for tax is 500 and this is 400. Advance tax. Okay, advance tax paid, let us say it is 300. Balance, closing balance. Okay, and here it is 350. Possible, you may say, sir, how can we pay less advance tax as compared to provision for tax? Maybe they determine the tax later, the tax got increased later, the estimation of tax got increased. in the, when the audit was finalized and then, they made a provision, but advance tax was not made possible. All these scenarios are possible. Don't break your head on why, advance tax is less than the provision for tax. Now, what does this mean? 400 was the provision for tax and 350 was the advance tax, and now 500 is the provision for tax and 300 is the advance tax balance. These are the balances. Generally, in practical life, if you ask me, the 2020 assessment will not get over in 2021. It will take at least 2 to 3 years time. Okay, but for an exam purpose, what you can assume is whatever is this advance tax paid 350, this would have been adjusted against the provision for taxation. This would have been adjusted against the provision for taxation, and most of the cases, this closing balance of provision for taxes represents current provision for taxes. So from the P&L, you have item, right? Tax expense, only the current tax, not the deferred tax. Provision for taxes is 500. For example, for the current period, this closing balance represents the tax from the P&L. If this is a different amount, then you can take that amount from the income statement. Now, when this information is given, how do we arrive at how much is tax paid? A lot of students get confused here. So a simple approach is to prepare two accounts, advance tax and provision for tax. And later I'll also tell you how to combine both the accounts for checking, or you can prepare that as a working note in the exam also. But though that is not the most logical way of doing it. Okay, so advance tax, what is the opening balance? 350. What is the closing balance? 300. Okay. So what you can assume is this advance tax what was paid for the earlier period has been entirely transferred to the provision for taxation account to settle off the opening liability. So provision for tax we had a balance, right? By balance brought down, provision for tax we had 400. So this opening balance of 350, I'll just put it in a different. This opening balance of 350 will be transferred to provision for tax account, assuming that the assessment is completed. So this entire 350 is gone. Okay, entire 350 is gone. But then what will happen is this 350 does not settle off the entire liability. You still need to pay 50. So what you can think is this balance of 50 has been paid either using the advance tax or directly through bank. That can be assumed. So we'll come to this balance later. Then in the current period, you have a tax expense of 500. Provision for tax, current figure, amount is 500. So by P&L, how much? 500. And the closing balance is also 500. Correct? So if you total this up, 850 here and 900 here, 50 has to be paid. So you have to get 50 from somewhere here. Okay. Then in the advance tax, you have a balance of 300. In advance tax, you have a balance of 300, which means you have paid here 300. And this provision for tax, whatever was the shortfall, was also paid to this account as 50. So total tax paid is 300 plus 50, 350. This is one way of looking at it. But if you are getting confused because you are handling, multiple entries, what you can assume is whatever was the, balance for provision for tax, entire amount has been settled using advance tax account. So you can have 400 here. Once you have that 400 here, this 50 is not needed. From advance tax account by provision for tax, 400 gets transferred here, and to bank you will have 350. So 400 plus 300, 700, 350 plus 350, 700. 400 plus 500, 900, 400 plus 500, 900. The total taxes paid is 350. Now, if you want to check this in the examination and if you are getting confused in the examination, what you can do is you can prepare a combined account. Combined advance tax and provision account. Okay. In that, what you can do is to balance brought down by balance carried down. What is balance brought down? Advance tax balance 350. What is balance brought down by on the credit side? Provision, which is 400. Okay. Then current year expense by P&L 500. Right. Then closing balance. On this side, you'll have advance tax balance which is 300. On this side you have to balance carried down. This side you have provision tax for advance tax balance. So this is 500. Now, if you sum this up, 1200, 850, the difference is what is paid through bank, which is 1200 minus 850, which is 350, right? So this is how you can calculate the amount related to payment of taxes. Now, whenever you are doing working capital changes, you will not consider provision for taxes in that calculation of the differences, because you are dealing with it separately by preparing an provision for tax and advance tax account, right? So this concludes the indirect method of cash flow. And for financing and investing activities, direct method, indirect method, both of them are same. You consider what has been received and what has been paid, right? So let us see if you have any questions on this. That voluntary separation payment is a one-off case. You can just practice that problem. They will not try to confuse you every time. But we don't know about the institute, so that problem we can cover it up. When should we see? If it is profit before tax, then you don't need to add back provision for taxation. If it is profit, see, as I told you here, you start with this, no confusion. So once it is profit before tax, don't add back provision for taxation again. Then only thing which will come is taxes paid. Okay, so you should not add back provision for taxes to PBT. Bank OD and cash credit generally from financing activity. Contingent liability treatment, if it becomes payable, then you would recognize it as a liability. Done. Right? So before I move to AS10, I have to also explain you one more aspect regarding fixed assets sold. So you have fixed assets sold. Let us say carrying amount. When I say fixed asset, it is PP. Okay, let us say carrying amount is 1000. Sale value is 1200. Gain is 200. Now this is the gain which will be credited to P&L. And when you do this adjustment, add less non-cash and other heads, here your adjustment will be this 200 only. It will not be the full amount. Whereas the sale value 1200 will come as cash flow from investing activity. We will show it as a cash inflow. We'll show it as cash inflow. This carrying amount does not have any relevance in the cash flow statement other than to compute this 200 of gain. Now, sometimes what happens is this is given as a missing figure. I always advise my students to prepare the PPE account, PPE disposal account, and accumulated depreciation account. Only when you prepare these three accounts, you will be in a position to calculate the sale proceeds or book value of assets sold or gain on sale of assets. Only then you'll be able to calculate properly. So, see, if the question gives you information on net book value, then you will prepare a single account. Okay, but if it has given you gross values, then please prepare PP account at gross value. Okay, from this gross value, transfer the amount relevant to this PPE disposal account. So what will happen is, from PP account, whatever is being sold will be transferred here. Relevant depreciation will also be transferred here, right? And then whatever is the amount received will be credited here, and you can find out the balancing figures based on that. See, cash credit, though it is short term, it is for financing purpose, right? So you'll classify it under financing activity. This class is specifically for accounting standards, so please don't ask questions related to other subjects. Okay, other subjects, other topics also. Exchange gains and losses, you are expected to give a reconciliation of foreign currency items, but that is, again, not covered as a part of your CA inter syllabus. That is covered when you do CA final, right? Pre-acquisition dividend, again, so what is pre-acquisition dividend? Dividend pertaining to period before acquisition. So you'll reduce it from the cost of your investment. So it will also be adjusted against your investment activity. So you'll show the outflow minus the inflow, right? I think I should open YouTube here. Just give me a moment. So I'm just opening my mobile phone, YouTube on mobile, so that it is easy for me to track your questions. SENVAT, MODVAT credit. SENVAT, MODVAT credit basically means the GST part, input GST. Earlier we used to have a concept of excise duty. They used to have SENVAT and all of that. The laws have changed. They have to update the accounting standards. Okay. Yeah. So this class is on YouTube, so it is available. You can actually, continue to watch this, right? Okay. Moving on. Accounting standard 10, one of the lengthiest standards as far as group 1 is concerned, but very easy, very simple. You just need to be clear with the concepts. Again, clear with the concepts, calculation will not be a challenge here. On lease assets, to the extent of revaluation part, you may apply AS10. Otherwise, leases you have separately under AS19. Okay. So AS10, property, plant and equipment. Earlier we used to have AS10. Just a second. Earlier we used to have AS10 only on fixed asset and depreciation was covered separately, AS6, but now it is fully covered under AS10, property, plant and equipment, both depreciation related aspect and fixed asset accounting related aspect. Okay. What are PPE? PPE are tangible items. So these are tangible items. Intangible items are covered by accounting standard 26, right? Which are held for use in the production or supply of goods or services. Remember the computer example? If you are using it for the production or supply of services, then it will be considered as a property, plant and equipment. Or for rental to others. Let us say I have cars. My business is to give those cars on rent to others. So those cars becomes my item of PPE. Or for administrative purpose. So building, office, corporate offices, right? Furnitures, all of those things which are for administrative purposes. Now, the standard includes this term administrative purpose because sometimes you cannot directly identify these future economic benefits with furniture. See, furniture is used to sit in an office, right? You can sit on the floor and also work. Or you may not need AC at all. Without AC also people work. So, just to ensure that you include those aspects, you have these administrative purposes included out here. Can you explain one question related to indirect method? You can please check indirect method on our YouTube channel. There is a detailed question which has been given, which is available, where I've actually explained you the entire logic end to end. Okay. So you can cover that. I don't want to complicate this discussion by solving problems because it will take a lot of time. The idea here is this quick conceptual revision before the examination. Okay. I hope you understand. Right? Okay. So where were we? for administrative purposes. So these are held for use in production, supply of goods or services, rental and administrative purposes, and are expected to be used during more than a period of 12 months. So the idea is, whenever you are buying these items, tangible items, you expect that you will use them for more than a period of 12 months, which means if you are buying some tangible item which will be consumed within 3 months or 4 months or 5 months period, then it will not be an item of PP. You will expense it off in the P&L, right? Sorry. Now, the next thing is recognition. Recognition means, when do you pass the entry in the books of account? When do you bring this item of property, plant and equipment into your books of accounts? Okay. Now you should bring this item of PPE. So the cost of an item of PPE should be recognized as an asset if and only if, means two conditions to be satisfied compulsorily. First one, it is probable that future economic benefits associated with the item will flow to the enterprise. Meaning to say, this item which we have purchased, because of that item we will get future economic benefits. So let us say we purchase computer. That computer we use to create videos. Using those videos we provide classes to our students. By selling those classes we make some money. We get future economic benefits. So because there is a future economic benefit associated with that item, that can be recognized as an item of PPE. Now someone may come up and say, why is this air conditioning needed, or why is this furniture needed? Now these are for administrative convenience. You will not be able to work properly if you don't have this administrative convenience. So indirectly these assets are also giving future economic benefits. May not be in direct monetary terms, but by using these assets you are able to get benefit from other assets. You have to look it from that angle, right? Then cost of the item can be measured reliably. Second condition is generally satisfied, because when you are buying a item of PPE, then cost can be measured reliably. You know what is the amount you are paying. But sometimes it may be possible that you are not able to measure the cost because you are buying it in an exchange for some other item for which you don't have a value. That may be a very remote situation, but generally the second condition is satisfied. The most important condition is the first one. Future economic benefits associated with the item will flow to the enterprise. Now please note, we have used this term. You can recognize it as an asset. Asset means what? Asset is a resource which is under the control of the enterprise. So control is also important here. And if it does not meet the criteria of this asset, or if it does not meet the criteria of future economic benefits, then what will you do? We will expense that cost to the P&L. So see the standard, what it says beautifully. Cost should be recognized as an asset, meaning to say this cost can be taken to balance sheet if these two conditions are satisfied. If these two conditions are not satisfied, you cannot take it to the balance sheet. You have to expense it in the statement of profit and loss. And at the time of initial recognition, measurement is always at cost. Now what is cost? Some things I've already discussed as a part of inventory. Similar concepts we can apply here. And in exchange of assets, what is to be done, that also we can apply here. Voluntary separation payment. See, if I have to explain you the voluntary separation payment, there has to be that full-fledged problem. What I'll try to do is I'll try to give that problem out right on YouTube. You can actually have a look at that, and it'll help you understand how do we treat that. Provision for bad and doubtful debts. Let us see if at all I'm taking up a final account session, or I'll try to pull that video out from my final accounts classes, and I'll put it, if possible, I'll put that on YouTube as well. I think that will help your queries. Okay. Then initially always measured at cost. Initially always measured at cost. Now what are the elements of cost? Purchase costs. Purchase cost means what is the amount that you have paid to purchase that item. Again, here you will apply similar principle that you have applied in inventory. If there are any refundable duties and taxes, you will not include. If there are any non-refundable duties and taxes, you will include. Then the aspects related to cost of transportation, cost of insurance, all the costs which are incurred to bring that inventory, to bring that item of property, plant and equipment in the condition and location as intended by the management. Whatever are the costs incurred, those costs are included as a part of cost of PPA. Once it is ready, let us say for example, you purchased a machinery, that machinery is brought into the factory, installed, then to that extent you will capitalize the cost. But next day the management says, no, we don't want this machine to be here, let us transport this from this location to some other location. That cost of relocation cannot be capitalized. Please note. you have to see what was the initial intention. Initial intention was factory location A, let us say city of Mumbai. Done. Next day management says from Mumbai, please take it to Delhi. Then that cost of transportation is not a cost of PPE. So if it is in the condition and location intended by the management, to till that extent you will capitalize the cost. So you'll have purchase cost, any directly attributable cost, and cost of dismantling and restoration at present value. Now here I'll just explain you in slightly detail what does that mean. This cost of dismantling and restoration is also called decommissioning liability. You'll understand this also as a part of AS29 when you learn AS29 in group 2. What is this decommissioning liability? Say for example, you have taken a taken a land, or you have taken a land on lease from the government. They gave it to you for 10 years. On that you have constructed a building. As per the condition which has been on which you have been given the land, when you give back the land to the government, the building has to be removed, the land has to be clear. This could be one example. Or sometimes what happens is you set up, let us say, a nuclear plant, or you set up some refinery. These are generally where there could be environmental disturbances in the surrounding areas wherever these plants are located. So let us say you have built a plant and you have permission from the government to operate that plant for 30 years. At the end of 30 years, the government requires you, or there is a law which requires you, or under a contract it is required that you have to dismantle the plant, you have to remove the plant, you have to clear off the surrounding areas, you have to bring the surrounding areas in a good condition, for which you need to incur certain expenditure. So we are not talking about expenditure today. This cost of dismantling and site restoration is not today's cost. Because you have purchased an asset today, because you have an item of PPE today, after 30 years, I have to incur certain expenditure. That expenditure, let us say, is 1 crore. Okay. That expenditure is, say, 1 crore. When are we incurring? After 30 years. So what the standard says is, please take some discounted, let us say 6%. Calculate the present value. Calculate the present value. Now, what is the present value? Present value is 1 crore divided by 1 plus 30% to the power of, not 30%, sorry, 6% to the power of 30. This present value, 17,41,101, should be the cost, should be added to the cost of PPE. Right. Then if I'm adding this to cost of PPE, I should also charge depreciation on this. This is a part of your cost of PPE carrying amount, decommissioning liability. Corresponding credit is a decommissioning liability. So you will say PPE debit 1741 and you will credit decommissioning liability credit 1741. Every year you will provide interest on this. So I can actually, opening balance, interest. There is no payment, so closing balance. What is the opening balance? Opening balance is 17,41,101. On this interest at the rate of 6%. Closing balance is this plus this. So this you continue to do for 30 years. This you continue to do for 30 years. th year and then the 30th year, you reach a balance of 1 crore. So every year, this is the interest which will be charged. You will debit this interest or finance cost. We also call it unwinding of discount, technical concept, and you will credit it to decommissioning liability such that at the end of 30 years, the decommissioning liability becomes 1 crore. Okay. So this is what is the concept of, present value of decommissioning liability, right? So these are the costs which are included in the cost of PPE, and once the item is in location and condition necessary for it to be capable of operating in the manner intended by the management, please ensure you remember this sentence, very, very important. Then you cannot capitalize any further cost. You have to stop capitalization of cost. Not annuity factor. Not an annuity factor, because here you are not making an annual payment. This payment is a single bullet payment. We call it bullet payment, single payment at the end of 30 years. Okay. Then what are excluded from cost? Similar to the things we learnt in AS2, administration and general overhead cost. Cost of opening a new facility such as inauguration cost. You build a factory is ready. Now you are doing an opening ceremony, ribbon cutting ceremony. You called some guests, you arranged a party. That cost cannot be capitalized. You have to expense that. Cost of introducing a new product or service, including cost of advertisement. So new product or service, that is a marketing related cost. You cannot capitalize it to PPE. Then sometimes there will be initial operating losses. Even that cannot be capitalized. Testing losses can be capitalized. See, if you have to, not testing losses, expenses for testing. If you have to test that plant and machinery to ensure that it is capable of being operated in a manner as intended by the management, you will include that cost. But if there are operating losses, you cannot capitalize. Then if there is a cost to conduct a business in a new location or a new class of customer, or you're training the staff, you cannot capitalize all of these items. Now, sometimes you get a question in the examination which says, a company purchased a land, it wanted to build a building on that land. Till the time the land was, building was being built, that land was given as a parking lot on rent. Can that income be reduced from the cost of this fixed asset? No, you cannot. That is a separate activity. You will treat it as other income. You have to answer this question. Is it necessary to bring that item to the location or to the condition necessary for it to be operated in the manner as intended by the management? If yes, then add that cost. Otherwise, don't add that cost. Right? So, very important: purchase cost, directly attributable cost, and cost of dismantling and restoration. Oh, thanks, Vaibhav, if you understood it nicely. Right. See, you understand the logic behind, and it becomes easy. Don't get into the zone of by hearting those things, right? So that will help you. So if there are CRR, that is your capital redemption reserve, in two comparative balance sheets, what does that mean? There is a movement. So it is from a cash flow, but I would like to address that query also because it's important. So the question is, there is CRR 2020, there is 21, there is some amount, 2020 there is some amount. Okay, now this CRR, whatever they have mentioned, let us say there is 1 lakh here and 75,000 here, meaning to say 25,000 has come into the CRR. Where will this 25,000 come from? It will either come from general reserve or PNL balance. So while calculating the PNL balance, you have to consider that this CRR balance has moved. So accordingly, while preparing the PNL account or general reserve account, you have to ensure this 25,000 transfer is also given effective. Okay. Then next question is next thing is on exchange transactions. So exchange transactions basically is barter. We may think that barter is not present, but standard prescribes this because this can be a tool to manipulate the financial statements. This can be a tool to manipulate financial statements. So what they would do, they have prescribed how you should value whenever there are exchange transactions. Exchange transactions are always measured at fair value. So if you are acquiring one item of PPE in exchange of a non-monetary asset or a combination of non-monetary asset or monetary asset plus non-monetary asset. See, monetary means you can determine or you can quantify in terms of money. Non-monetary means you cannot quantify. Okay. So if you are acquiring an asset in exchange of a non-monetary item, then or non-monetary assets, then you will measure it at fair value. Fair value of what? What fair value should we use? Should we use the fair value of asset given up or asset acquired? Can you quickly answer? Let us see on how many of you have clarity on this. Fair value of asset given up or fair value of asset acquired? Just waiting for the answers. There's some issue with my mobile phone. Okay. Yeah. Okay, I'm again repeating the question. I said whenever there is exchange of asset, it has to be measured at fair value. Fair value of which asset? Asset given up, that is the asset which you have given, or asset acquired, the property, plant and equipment that you have acquired. Which one should be used? Acquired, given up, acquired, given up. See, acquired, given up, acquired, given up. First preference is asset acquired. Asset acquired. Okay. If you go back and see examples in a study material, or if you go back and see the classroom notes, you'll understand that it is not asset acquired but asset given up. Only few of you could say asset given up. A lot of you said asset acquired. Please go back and see what have you done in the study material question or in the classroom question. Okay, so simply put, I'll actually take up a question from the material so that it is easy for you guys to understand. I'm opening the study material so that you recall. Okay. Remember this question? Entity exchange land with a book value of 10 lakhs for cash 20. We'll come for this cash part, and plant and machinery valued at 25 lakhs. What will be the measurement cost of the asset received? Right? So, for the measurement of asset received, you'll always see what is the asset you have given up. You have given up cash of 20 lakhs and plant and machinery of 25 lakhs. Oh, sorry, this is another question. So here land has been given book value of 10 lakhs for cash of 20 lakhs and plant and machinery value of 25 lakhs. They have not given the value of, fair value of land given up, but just to make it very clear, you will always see fair value of assets given up. Okay, fair value of asset given up. I could not locate the exact question in the material, but nonetheless, the concept is fair value of asset given up, which includes non-monetary assets as well as monetary assets. Okay. Now, if this fair value of asset given up cannot be determined, then fair value of assets received. If fair value of asset given up is also not determinable, if fair value of asset is also not determinable, then carrying amount of assets given up. Okay, so this is one part of it. Second part is you have to check that there is commercial substance. What do you need to check? There is commercial substance. Now, what is this term commercial substance? Commercial substance means by exchanging that asset, the configuration of cash flow is changing. In other words, maybe the nature, the timing of cash flow has changed, or the amount of cash flow has changed, the risk associated with cash flow has changed. There has to be some change in the cash flows associated with those assets. So, if for example, I exchange my computer with another computer, both of them have similar functionality, similar utility, cash flows are also not expected to change, then there is no commercial substance. Whereas, if I give up, let us say, a patent and I acquire a computer software, then there is commercial substance because I am exchanging two different categories of assets. Also, if I am exchanging an old asset and I am getting a new asset, even then there is commercial substance because of the new asset, I will be in a position to get better cash flows. Are we clear? So, if the transaction lacks commercial substance or fair value of asset given up and acquired cannot be measured reliably, then In that case, you will use carrying amount of asset given up. Otherwise, you will use fair value of asset given up. Are we clear? Okay, so we are in AS10. So before that, it has been completed. You can continue from AS10 till end, and remaining you can get back, come back and see later. Okay. Yeah, I will share the material in the description box. Okay, I'll put it up, or I'll put it in the comment itself. It is easy actually. You can you can come over here. Those of you want to get the material, just click on free resources in indigoloan.com. You can see notes here. CA Inter New. Here is this accounting standard summary notes. Okay, so accounting standard summary notes group 1. This is the file I am referring to. You can download this. Full notes are available here. Okay. Yeah, coming back to the discussion, then initial recognition is completed. Initial recognition is done. Now we're talking about subsequent cost. Subsequent cost, if they are in the nature of day-to-day repairs, servicing, maintenance, you will expense them. You will not capitalize them. Always remember, for subsequent cost also, you have to check this condition. Future economic benefits and cost can be measured reliably, but day-to-day smaller repairs and services are more related to maintenance. They will not significantly change the future economic benefits, and hence they will not be capitalized. Whereas if there are replacement costs, then you will recognize it as an PPE and existing part is de-recognized. This is also done in a case where initially you had purchased assets and recognized them as a single item or single category. Now, what do I mean by that? Say for example, we have camera at our studio. Now that camera has, one is the camera, then second there is a battery. Battery is also, it has a significant cost in relation to the camera, and it has a life of 3 years. After 3 years, if I am changing the battery, after 3 years I am changing the battery, I am replacing a part of that, camera, then this battery, new battery that I am purchasing will be recognized as an item of PPE, and old battery will be de-recognized from the books. Old battery will be de-recognized from the books. Now, how will we get to those old battery? We can use inflation and we can do a backward calculation and identify what should have been the carrying amount of that battery had that battery been capitalized separately, and to that extent you can de-recognize. But don't worry, you will not be tested in that much of depth. But please note, replacement cost is also recognized as PPE if it meets the recognition criteria, and existing part has to be de-recognized. You have to estimate the value of existing part and you have to de-recognize that. Then, if there are major inspection costs, this happens in case of aircrafts, ships and all of those things where you need to carry out major inspections frequently. Let us say once in 3 years or once in 5 years, even that is recognized as a part of PPE. Okay. So what actually happens is, though it is not covered in so much of depth for Inter at the level of CA Inter, what actually happens is whenever you purchase an aircraft, so for the first 3 years, you don't need to carry out any inspection. So it is assumed that this inspection cost is also a component of the cost of the aircraft, and you will do the accounting and depreciation accordingly. Okay. So that is what is done with the subsequent cost. Then if at all there are deferred payment means you are not paying immediately everything in cash, partly you are paying in cash and partly you are paying it at a future date. Now, if there are deferred payments, then you have to calculate the cash price equivalent. And you will account for PPE at cash price only. Now, what do I mean by that? Say, for example, you buy a item of PPE. Payments are at the end of year 1 and 2 and 3. 3 years you have to make the payment. 50,000. 50,000, 50,000. Okay. There is no advance payment, for example. Just assume that there is no advance payment. These are deferred credit terms which are given by the supplier. And assume that the rate, implicit rate of return or internal rate of return in this transaction is 10%. Or otherwise, you can calculate the cash price and find out the IRR. That is also possible. I am not getting into all of that. What is the present value factor? 1 divided by 1.1 for the first year. This number divided by 1.1 for the second year, and this number divided by 1.1 for the third year, right? This is the present value factor. What is the present value? 50,000 multiplied by this, 45,000, and these 3 periods. So if you sum this up, this is the cash price equivalent. So you'll recognize the PPE at 124,342. Corresponding liability also at 124,342. Okay, then every year you will calculate interest. Opening balance, interest, payment, closing balance. What is the opening balance? 124,342. What is the interest? At the rate of 10%. What is the payment? Payment is 50,000. What is the closing balance? Opening balance plus interest minus payment, which is the closing balance, right? Then opening balance is 86, interest is 8,677, payment is 50, closing balance is so much, opening, interest, payment, closing is 0, right? So every period, this part is considered as interest, and what do we do with that interest? Refer to accounting standard 16. If it is for a qualifying asset, capitalize. If it is not for a qualifying asset, expense, right? So this is what is done for deferred payments. Moving on, subsequent measurement, there can be a cost model and there can be a revaluation model. There can be a cost model and there can be a revaluation model. What is this cost model? Cost model is, you will initially, we said, right? You will initially measure an item of PPE at cost. Initially, you will measure item of PPE at cost. Then whatever is the accumulated depreciation and whatever is the impairment. So impairment is it's not a part of your group one, so don't worry about it. Impairment basically means asset will not be giving us benefit to the extent we had expected. Okay, so under the cost model, what you will do is you will measure that asset initially at cost, reduce accumulated depreciation and reduce accumulated impairment. Under the revaluation model, you will calculate something called the revalued amount. What is this revalued amount? I will take one example and understand this. Revalued amount is basically at the end of each balance sheet or at frequent intervals, maybe at the end of 2 years or 3 years, you will try to calculate what is the fair value of that asset. Okay, and you will bring back that asset to this revalued amount. So, say for example, I purchased a land some 5 years back. Okay, if I'm following the cost model, I'll continue to carry at cost. I'll not depreciate land because it does not have a useful, definite useful life. It has an indefinite life, right? So under the cost model, it will be shown at cost only. Under the revaluation model, what you will do is you will see, okay, what is the value of the land today? I purchased at, let us say 10 lakhs or 1 lakh, whatever is the number. Today the value is 20 lakhs or 2 lakhs. If it is 20 lakhs, then I will show land at the cost of, at a value of 20 lakhs. In the books of accounts, I will show land at a value of 20 lakhs. And then on that 20 lakhs, I'll calculate depreciation and continue to, charge depreciation in the books. Okay. So this is the cost model. This is the revaluation model. So let us see what happens. Original cost is, let us say 1 lakh and useful life is say 10 years. So depreciation will be 10 lakhs divided by 10 years, 1 lakh. Sorry, I wrote 1 lakh. So 1 lakh divided by 10 years, 10,000. Carrying amount will be 1 lakh minus 1,000, 10,000, 90,000. This is under the cost model. Under the revaluation model, let us say first year it is the same thing. First year it is the same thing. Now, what happens is in the second year, so this is the first year. In the second year, what will happen? Again, original cost, let us say depreciation for 2 years divided by 10 multiplied by 2, carrying amount is 80,000. But here, under the revaluation model, what we have done is we have revalued this asset. Revalued means basically calculated the fair value based on market conditions, arm's length transactions, all of those things. Then the fair value of this asset is determined to be 1,20,000. Fair value of this asset is determined to be 1,20,000. Then what will we do? At the end of second year, the carrying amount, or at the beginning of the second year, not at the end, so that we can calculate depreciation. Carrying amount is now how much? 1,20,000. Carrying amount or the revalued amount is 1,20,000. Now what's happened here? From 90,000, you have taken that asset to 1,20,000. So there is a revaluation surplus of 30,000. You have a revaluation surplus of 30,000. What will be the entry? The entry will be property, plant and equipment. You have increased by 30,000, and you will credit revaluation surplus by 30,000. I'm not writing to from and to, just understand this as debit credit. In examination, you have to write PPE debit to revaluation surplus. You will credit this surplus to revaluation surplus account. You will not credit it to P&L. Please note this. Then on this carrying amount for remaining 9 years, what will be the depreciation? 120. Now 9 years are left, right? Beginning of the second year means 9 years are left. Depreciation will be 13,333. Carrying amount will be 120 minus 13,333. Okay, this is how you will continue to provide depreciation in the books. Now, revaluations surplus, first time when you are doing a revaluation, if it is an upward revaluation, you will credit that amount to revaluation surplus. If it is a downward revaluation, then you will debit that amount to P&L. So, look at this. Increase, you are taking it to revaluation surplus. Decrease, you are debiting to the P&L account. So whenever there is an increase, you will credit it to revaluation surplus. If there is a decrease, say instead of 120, this came out to be 80,000. In that case, you will debit it to the P&L, right? This is the first time revaluation. Subsequent revaluation, when you are doing subsequent revaluation, then if there is an increase, if there is an upward revaluation, then you will credit it to revaluation surplus. Or if earlier you had debited to P&L, now you will credit to P&L. Sorry. So, upward, first time, what will you do? You will credit to revaluation surplus. Subsequent, credit to revaluation surplus. Or if you had earlier debited to P&L, now you will credit to P&L. Downward revaluation, first time debit to P&L. Subsequent, either you will debit to P&L, or if there was a revaluation surplus done here like this, in that case you will debit to revaluation surplus, depending on where is the balance available. 30,000 is carrying amount at the end of first year, and when you did the revaluation at the beginning of the second year. Okay, theoretically one day the value will not change so much, but just giving you an example. So 90 to 1,20,000, 30,000 is the revaluation surplus. Okay, then what do you do with this revaluation surplus? Either based on the depreciation difference, you can transfer it to the P&L, or you can transfer it to the general reserve, sorry, not to the P&L, or at the end of the useful life of that asset, whatever is the balance in revaluation surplus can be transferred to the general reserve. So what I'm trying to see here is, see, because of this revaluation, year 2 depreciation is 10,000 for the year, and here year 2 depreciation is 13,333. Means what? We have charged excess depreciation of 3,333. This excess depreciation can be transferred from revaluation surplus to general reserve. Okay. Yeah, so you should calculate depreciation including the revaluation surplus or revaluation deficit. Okay. Then moving further, depreciation. I just tried to summarize everything in these 5-6 bullet points because that captures the crux of the depreciation as far as this chapter is concerned. So now one thing that is new in AS10, which was not there earlier, is component wise depreciation, which says each part of an item of PPE with a cost that is significant in relation to the total cost should be depreciated separately. Meaning to say, if you have an item of PPE, think of an aircraft. Think of an aircraft, right? Aircraft has engines, aircraft has a body, aircraft has chairs, right? Chairs have a different useful life. Chairs has a different useful life. The body has a different useful life. The machine has a different, engine has a different useful life. And the cost is also, each of those costs are significant. So try to identify those parts which have a cost which is significant in relation to the total cost of the item and depreciate them separately. Depreciate them separately. Component wise depreciation. So So does it mean that in the balance sheet also will show aircraft body separately, engine separately, chair separately? No, we will show it as an aircraft. But as far as the background depreciation is concerned, when you are calculating the depreciation, you will split that into the respective parts or respective components. Then the standard says the depreciable amount should be allocated on a systematic basis over its useful life. This is the principle, right? How to allocate? You can use straight line method. You can use written down value method. You can use units of production method also. Units of production means based on the number of output or number of units of production, you can allocate the depreciation. Now, depreciation is an expense which represents the consumption of the property, plant and equipment. You have purchased an item of property, plant and equipment which is expected to have a useful life of 5 years. So basically you are expensing this item of PPE over a period of 5 years by using depreciation. But if this property, plant and equipment is used for construction of another asset, let us say property, plant and equipment is used for manufacturing of inventory, then as an overhead you will add it to the cost of inventory. Or this machinery is used for construction of building, as this depreciation becomes the cost to the building, and that building again will be depreciated. Okay, so depreciation for each period should be recognized in statement of profit and loss unless it is included in carrying amount of another asset. Another asset here basically means it could be an inventory, it could be an intangible asset, it could be another tangible asset. You have to add it to that. Then while calculating depreciation, the fundamental thing is depreciation is generally equal to original cost or carrying amount minus residual value divided by estimated useful life, right? This is the straight line method. You can use, there is a formula to calculate the rate for return on value method also. In that also you will need to know what is the residual value, what is the estimated useful life, right? So at the end of every period, residual value and useful life should be reviewed at each balance sheet date, and any change is accounted for as a change in accounting estimate as per AS5. This can be a question, either in group 1 or in group 2. Depreciation specifically, change in method of, or change in estimates of useful life or change in estimates of residual value will be treated as change in accounting estimate. Then depreciation method also should be reviewed at least each financial year, meaning to say we are using SLM, maybe WDV gives a better presentation, or maybe unit of production gives a better presentation, and now you want to change from WDV to SLM to WDV. Even that is considered as a change in accounting estimate as per accounting standard 5. Okay, and this depreciation method should reflect the pattern in which assets' future economic benefits are expected to be consumed by the enterprise. So basically, in what pattern is it expected to consume? The entity is consuming that fixed asset or getting that benefit. In that pattern, it has to be, the depreciation method should reflect that particular pattern. So you may use unit of production, you may use WDV, you may use SLM, provided it reflects the pattern in which the future economic benefits are consumed by the entity. Basically, the matching concept principle. Okay. Then retirement, whenever you are retiring, and PP retirement means now you are no longer using it and you have held it for disposal, you should state it at lower of carrying amount. Carrying amount means the original cost minus depreciation minus impairment, that is the carrying amount, or the net realizable value. If there is any loss here, then you have to again take it to the statement of profit and loss. Okay. Then derecognition. Remember we spoke about recognition. Recognition is when you bring it to the books. Derecognition is when you actually expense it out. So you should derecognize when no future economic benefits are expected from its use or disposal, or on disposal. So if you have disposed of, you will derecognize, or if there is no future economic benefits, then also you will derecognize. Then gain or loss on derecognition is recognized in statement of profit and loss. That's a very simple thing. Gain or loss will come there. What is the gain or loss? Whatever is the carrying amount minus whatever is the value that has been realized, that is the gain or loss. Okay, so this concludes accounting standard on property, plant and equipment, right? So we have completed 1, 2, 3 and 10, right? I think the 4 standards that we have completed. Now we are left with accounting standard 11, 12, 13 and 16, right? And the time available is only 20 minutes. Probable questions from PPE. Okay, probable questions would be, they may give you items, 5-6 items, and they may ask you which one can be capitalized, which cannot be capitalized, or they may ask you, there is a ribbon cutting ceremony, can we capitalize the expense, or training, can we capitalize that expense, initial operating losses, can we capitalize that expense. If you go through the study material questions, right, in which is given in the study material, then you will cover most of the varieties of the questions that can be asked. There is a specific question on this, exchange of asset, which we had left it, right? Yeah. So here there is one question. Entity A exchanges land with a book value of 10 lakhs. So land has a book value of 10 lakhs for cash of 20 lakhs and plant and machinery valued at 25 lakhs. So what is happening here? Entity A is giving up land worth 10 lakhs in the book value, in book value, and it gets 20 lakhs and plant and machinery at 25 lakhs. What will be the measurement cost of the assets received? Consider that the transaction has some commercial substance. So if the transaction has commercial substance, you have to apply fair value. Fair value of asset given up 10 lakhs is not, it's not available, right? This is the book value. So you will use fair value of asset received, that is 25 lakhs. So what will you do? You will value this plant and machinery, whatever you have received, at 25 lakhs, cash of 20 lakhs, and this land will be given up at 45 lakhs, which is 20 plus 25. So there will be a gain of 35 lakhs. Okay. Then here you have another thing. Exchange A exchanges car with a book value of 13 lakhs and a fair value of 13 lakh 25,000 for cash of 15,000, and car Y, which has a fair value of 13 lakh 10,000. Let me just note it down. It will be easy. Entity A exchanges car X with book value. Car X book value of 13 lakhs and fair value 1325. Okay. For cash of car Y, so what is received? This is asset given up. Received is 15,000 cash and fair value 1310. Okay. The transaction lacks commercial substance. The transaction lacks commercial substance as the company's cash flows are not expected to change as a result of the exchange. It is in the same position as it was before the transaction. What will be the measurement of the cost of asset received? In this case, what has happened is you have given an asset with a book value of 13 lakhs. Now, when you gave up an asset of book value worth 13 lakhs here, I'll just share my screen so that it is visible. When we have given up book value worth 13 lakhs, then whatever we have received in return, cash you can directly measure, right? So first this cash will adjust against the book value, and the balance 12,85,000, whatever is left, will be the value that you will assign it to car Y. So you'll measure it at carrying amount of asset given up. So what is the asset given up? 13 lakhs. This 13 lakhs will be split between this cash of 15,000 and balance will be given to this car Y of 12,85,000, right? So this is the thing for property, plant and equipment. We'll have a follow-up session on Monday where we'll be covering AS11, AS12, AS13 and AS16, and we'll also be picking up a couple of past exam question papers and we'll try to solve them, or at least have an idea of how to solve them in the examination situation. Hello my dear students, welcome back to part 2 of revision for accounting standards for group 1. So in the previous session we covered from accounting standard 1 till accounting standard 10. Today we will be taking up accounting standard 11. One standard which in group 1 students find some level of difficulty and they are actually concerned, they are sometimes they're scared that how should we handle when accounting standard 11 related questions are asked. But let me tell you, this is a very simple standard. Again, it is purely logical based. Once you understand the underlying logic, then solving problems from the standard will not be difficult. Okay. Difficulty would arise, rather complexity would arise when you learn, forex management in strategic financial management in CA final. But for now, I don't think the standard poses too much of a challenge for the students, right? So accounting standard 11, this deals with the effect of changes in foreign exchange rates, right? So the title of the standard is effect of changes in foreign exchange rates. Now, when would this situation arise? Whenever an entity is transacting in a foreign exchange. So to put it very simply, let's say there is a company based out of India whose functional and whose reporting currency is the INR. If they are transacting in US dollar, how should they account for effect of those changes? So let us say Infosys is selling goods or selling not goods, sorry. If Infosys is selling its services to a foreign company, it is exporting its services to a foreign company, then maybe the billing is done in INR. Maybe the billing is done in INR. In that case, no problem. But in most of the cases, whenever there are exports to a foreign company, then billing might be done in US dollars. Now, if the billing is done in US dollar, for reporting purposes in India, you have to record them in INR. Now, this standard gives guidance as to how should you record those transactions, how should you, settle those transactions, what happens when there are changes in foreign exchange rates. To give you a perspective, when I was doing my articleship, the exchange rates used to be 40 to 45. When I was, working as a CA in companies, the rates used to be 60 to 63. That is the rate which I used to use, which I used to close the books of accounts. Today, you can see the rates are 73, 74. So what happens when the foreign exchange rates changes and how should that be accounted for? Now, before moving on to the accounting aspect, we need to understand two critical terms, which is monetary items and non-monetary items. These are basically classification of assets and liabilities. Now, what do I mean by monetary item? Something which is fixed in money terms, meaning to say, you can determine or you can tell for sure what is the amount in terms of money you would be realizing if you sell off that asset, or the money that you need to pay to settle a liability. For example, there is a debtor. That debtor has to pay you 1000 rupees. Now, is this 1000 rupees fixed? Yes, it is obviously fixed. It is not going to change. Maybe the debtor may become bad debt, then that's a different thing. But can you say tomorrow that that debtor will pay me 1500? You cannot say that because the amount is fixed. Such items are called monetary items. Example could be loans. If you have borrowed loan from any bank, what is the amount that you need to pay back? That amount is fixed. What is the interest that you need to pay back? That amount is also fixed. So these items are monetary items are money held, so that is obviously a monetary item, and assets and liabilities to be received or paid in fixed or determinable amounts of money, meaning to say the amount that you will pay is determined, it is fixed, right? Now, examples as I told you, debtors, it could be loans, it could be trade payables, it could be sundry creditors, what you may call. All of these are known in terms of money. They will not change. There may be a bad debt case, there may be a settlement discount and all of that, but the amount that you will receive is fixed and determined. These are called monetary items. Then what are non-monetary items? For which the monetary value is not fixed if you want to realize that asset or if you want to settle that liability. For example, there is a plant and machinery which the company has purchased. You may get future economic benefits, but do you know what is the amount you will get if you have to dispose of that asset? Or can you for sure say that this is the exact present value of future economic benefits, this is the amount that you will realize if I settle? That is not possible. So such items are called non-monetary items, right? So there could be, let us say, I've invested in equity shares, those are non-monetary items. If there are preference shares are also non-monetary items, because when the company gets wound up, or if it is being liquidated, you may not have sufficient money to pay back to the preference shareholders. So even those are non-monetary items. Now let me ask you one question. Is inventory a monetary item or a non-monetary item? So let me look at the responses. Is inventory a monetary item or a non-monetary item? Monetary, non-monetary, monetary. Now please note, to call something a monetary item, we are getting multiple responses. Some are saying monetary, some are saying non-monetary. Is it an asset to be received in fixed amounts of money? You may say, as per our previous discussion, it will be valued at lower of cost or net realizable value. That value is fine. But do you know what is the amount you will receive when you sell that inventory? You do not know. Maybe once you sell the inventory may be sold at still a lower rate, right? So inventory is not a monetary item. Inventory is a non-monetary item. Once you sell it, once there is a debtor in place, that becomes a monetary item. Inventory is not a monetary item, it's a non-monetary item. A lot of students get confused here, but you can just note it down somewhere that inventory is non-monetary because the amount that you will receive, is not fixed and determined. The value keeps on fluctuating till the time you sell that particular item. Okay. Now, having understood this, let us understand the accounting aspects related to foreign exchange rates. I'll take a simple example and I'll run you through the example so that you can understand what is to be done when there is a liability to be settled or exchange rate changes. You'll understand that. So let us say there is a company in India, Infosys, and there is a client in US. For example, let us say Amazon US. Okay, this is based out of India, and this is based out of US. What is the currency which Infosys would use to report, to prepare its financial statements? INR. And while selling, let us say the sales happen in dollar terms. And on a particular date, let us say on 1st of January of 2021, Infosys sold services worth $10,000. Infosys sold services worth $10,000. Now, the amount is not yet received. Amazon has not yet paid the amount. There is a 6-month credit period which is provided. Okay. Now, what is the entry for sale? You would say Amazon account debit. By how much? $10,000. But you will not be recording this at $10,000. You will convert that into equivalent INR. At which rate? The rate prevailing at the time of transaction. Now, see, the exchange rates keep on fluctuating. Okay, second on second, the rates will fluctuate. So it can be on the basis of the date of the transaction, maybe the closing rate of that date, or maybe average rate of that date, or maybe the bank quoted rate on that date, or maybe it can be anything, but there has to be consistency. So an entity may say we will follow RBI reference rate. You may follow RBI reference rate. Some entity may say we will follow the rates given by the banks. So the corresponding banks, whatever rates they give, that is the rate that we will be following. Okay. Some may say we'll take the average. All of that is fine. So on this date, whatever is the rate, at that rate you will book this transaction. So assume for a moment on this date, the exchange rate, that means amount of rupees that you will get when you sell $1 is, for example, 75. Okay. So what is the value? 10,000 multiplied by 75, you get 7,50,000. Right? 7,50,000 Amazon account debit. Then to sales 7,50,000. Done. No problem. Right? Now the year ends on 31st March of 21 and the amount is still outstanding. Okay. What the standard says is all the monetary items should be restated when the financial year ends. All the unsettled monetary items should be restated when the financial year ends. Now, is this account a monetary item? Yes, it is a sundry debtor and it is a monetary item. So you have to restate this amount. You have to restate this account. What is the value that you should use to restate the amount? The closing rate. What is the closing rate? Say, for example, in our case, the closing rate is 70. See, when we sold when the rate was 75, $10,000, we would have got 7,50,000. Because on 31st March of 21, the rate is 78, which means we will get 7,80,000. 75 multiplied by 10,000 is 7,50,000. 78 multiplied by 10,000 makes it 7,80,000. Means you will get more. If you get more, is there a gain? Yes, there is a gain. So the standard says this gain should be recognized in the P&L for a restatement of all monetary items. It can be a purchase for which there may be a creditor. Exchange rates would have increased. There is a loss. That loss also should be recognized. All profits or losses or gains or losses arising out of foreign exchange transactions will be recognized in the statement of P&L. Now you may have a doubt. What if Amazon paid us the amount on 20th March? Possible? Yes, possible. So there could be a scenario where Amazon paid us the amount on 20th February. Sorry, not 20th March. I'm saying 20th February. And the exchange rate is 76. What will happen in that case? This is option scenario 1. In this scenario, you will receive 76 multiplied by 10,000, $7,60,000. So bank account debit will be 76 multiplied by 10,000, $760,000. Okay. Then to Amazon account. Amazon, the balance is 750 only. It is not increased. The difference will be gain to exchange gain. What is the exchange gain? 760 minus 750. Exchange gain means basically foreign exchange gain. This is the gain that you will recognize. This is the first scenario. This is the first scenario. If the transaction is settled, any gain or loss arising, this will be taken to P&L. Now assume the transaction is not settled on 31st of March, the exchange rate is 78. What would you do in that case? Now amount receivable is not 750, amount receivable is 780, considering the exchange rate on 31st of March. So you would say Amazon account debit 780 minus 750, 30,000 to exchange gain. This is unrealized. Okay, exchange gain unrealized 30,000. Even though if it is an unrealized means you have not yet received in terms of cash. Even in that case, you will credit it to the P&L, right? So this is the gain on restatement of debtors, right? So any exchange gain or loss arising out of settlement of a foreign exchange transaction will be taken to P&L. Either you will debit to the P&L if there is a loss, if there is a gain, you will credit to P&L. Now assume for a moment this transaction was settled on 30th of June of 21 when the exchange rate is 77. Now tell me, what will be the gain or loss that should be recognized in the period ending 30th June of 21 or in the financial year 21-22? Initially we recognized it at 75. Then the rate was 78. We recognized a gain of 30,000. Now the settlement happens when the rate is 77. What should be the gain or loss that should be recognized in the P&L? Okay, so we're getting responses. 10,000, loss of 10,000. Okay, others, do you think loss of 10,000 or gain of 20,000? Guys, you need to participate. Only when you participate, you will take some knowledge out of this session. This is not a session just to sit and listen. Okay, so 10,000 is the loss. I think that is what has been the response. So you will recognize a loss of 10,000. Now the entry would be bank account debit. You would get 77 multiplied by 10,000, that is 7,70,000. To Amazon account. How much is the Amazon account standing at? Initially we had booked at 750. Now we added 30 to this, it became 780. And to exchange loss of 10,000. To exchange loss of 10,000, right? So net 30,000 of gain and 10,000 of loss. Net gain is 20,000, but 30,000 will be recognized in the financial year ending 31st March of 21. This is scenario 2. Okay, and here in the year 21-22 you will recognize a gain of 10,000. This is the underlying fundamental principle of this accounting standard. All the monetary items have to be restated on the balance sheet date. That is one thing you need to remember, and that will be, you will apply the closing rate for monetary items. That is the second thing you need to remember. If the transaction has been settled, any gain or loss arising out of that settlement of transaction will be recognized in the statement of profit and loss, right? Simple. I don't think there is much complication here. Okay, but always remember, you are restating only monetary items. We are not restating the non-monetary items. We are restating only the monetary items. So exchange difference, the difference resulting from reporting the same number of units of foreign currency in the reporting currency at a different exchange rate, that is the exchange rate difference. Foreign currency transaction initially we recorded at exchange rate on the date of transaction. Then foreign currency monetary items
you will value them at closing rate. Exchange difference, you will take it to P&L. So it could be, it need not be always an expense, it can be an income also. Okay, so it can be an income as well as an expense in the respective financial year. Now there is an exception given by para 46A. Now this is one aspect which is frequently tested in the examination. This was introduced when I was a student of CA final, right? When I think 2008 or 9, when there was this global crisis going on and exchange rates were fluctuating wildly, and the companies had to take a lot of these expenses hit because of depreciation of INR. So what the government came up and said is, if it is in relation to, if there is a monetary item in the balance sheet in relation to depreciable asset. So what does that mean? Say for example, a company has taken a loan of $100,000. Okay, loan taken is $100,000. Rate when the loan was taken is, let us say, was 45. Rate on which the loan was taken is 45, and rate on balance sheet date is, let us say, 50. Okay, so what happens? You have taken a loan. When you took the loan, you booked it at 45. Now the rate is 50. There is a 5 rupee loss. So the loss is 50 minus 45, 5. So total loss, $1 lakh multiplied by 5 lakhs in INR terms. This is the loss. General rule is what? Debit to P&L. Okay, but what happened was, during that period, companies had crores and crores of losses on account of foreign exchange differences. So what the company said is, if we start reporting these losses, our balance sheet will be really damaged. It will not give a true picture because this may be a temporary phenomena. So government introduced this para 46A, where they gave an option to the entities to capitalize this exchange difference, to capitalize this exchange difference. Now, please understand, this is an option which has to be exercised, and once exercised, you have to continuously follow that. So let us say this year there is a loss, you will add it to the cost of asset. If there is a gain next year, you will reduce it from the cost of asset. So you will adjust it to the cost of that particular asset. It is not that whenever there is an expense, I will capitalize, and whenever there is a gain, I will take it to the income statement. That is not permitted. Once you have taken this option, you have to follow this consistently. That is the first thing. Second thing is, you will also understand in accounting standard 16 that the exchange losses which compensate for the interest savings, to that extent you will consider them as borrowing costs. So that is a separate treatment altogether. Okay, here whatever is the exchange loss which comes within the purview of AS11, to that extent what you need to see is, if the entity chooses the option under para 46A, then you can capitalize, that is add it to the cost of asset or reduce it from the cost of asset. Otherwise you will expense it off. Okay, so exchange differences in respect of a depreciable asset, if the entity chooses, we can adjust it to the cost of the asset. In other cases, meaning to say, where there is not a depreciable asset, it may be a non-depreciable asset, or it may be some other item of non-monetary asset presented in the balance sheet. In that case, you will accumulate it to FCMI TDA account. What is this FCMI TDA account? Foreign currency monetary items. So we are talking about monetary items. Translation difference account. Translation difference. You will accumulate in this account and amortize it over the life of that particular asset. Okay. So this is the rule that is generally followed. As far as non-monetary items are concerned, you will use the exchange rate on the date of transaction, or if fair value approach is being followed or revaluation model is being followed, you will use the exchange rate on the date of valuation. So for inventory, you will use exchange rate on the date of valuation of the inventory. For fixed assets, you will use the exchange rate on the date of transaction. Now this is for conversion of non-monetary items. Now where would we apply this concept? You would apply this concept when it comes to foreign operations, where they have integral operations and non-integral operations. You will apply this principle, and also there would be a lot of application of this when you learn about accounting for branches in a separate chapter, right? So I hope this brief discussion makes sense. If you have any questions on this, you can just let me know. Exchange rate should be debited. Oh, sorry. Can make mistakes. Okay, guys, you understand the underlying substance over form. Substance is, it is debited. I've written in the debit column. Yes, I should not have written 2 here. Okay, good that you caught that. You should be good auditors. You should be able to catch such mistakes. Okay, just because some CA has passed the entry does not mean that it is always correct. Abhishta says unable to understand the entries. So it is. I think I have explained the entry as I was computing. If you have missed the initial part, you can go back. So services were sold 10,000 into 75. It is 7,50,000. Scenario 1, exchange rate is 76. So the total amount is 7,60,000. 10,000 is the gain. Closing rate, if it is 78, then the gain is 30,000 because 78 multiplied by 10,000 makes it 7,80,000. Minus 7,50,000, there is a gain of 30,000. Okay. Then when you actually realize, you realize 7,70,000, exchange loss of 10,000, and Amazon account 7,80,000. Is there any compulsory rule to follow? No, there is no. It's an option. Add the option of the entity. If they want, they can use it. If they feel that it is fine, perfectly fine. If you don't want to use that, then that is also perfectly okay. FCMI TDA is, just write it here, foreign currency monetary item translation difference. Now, what does this mean? If the entity chooses to apply this para 46A option, if it is a depreciable asset, you will either debit or credit to the corresponding fixed asset or PPA. Okay, if it is not a depreciable asset, then you will accumulate this difference to, you will debit or credit the difference to FCMI TDA account. You will debit or credit the difference to FCMI TDA account. Okay. Now, what will you do with this balance of FCMI TDA account? Over the life of that asset, you will amortize it systematically. Okay. Now, such depths of questions are not tested in the examination. If you just understand that it has to go to FCMI TDA account, or if it is related to depreciable asset, you will debit or credit it to fixed asset. That is sufficient. Okay. Right. Moving on, we have these foreign operations, which is also covered as a part of your accounting for branches. So I'll just be covering that part which relates to foreign operations. Foreign operations means there is let's say an Indian entity, it has an operation outside India. Maybe there is a branch office outside India. Maybe there is a subsidiary outside India. Now, they have been classified into two categories, integral and non-integral. Integral means it is as if the branch is also a wholesome part of the entity which is reporting the transactions. So let us say in India, you have Infosys or you have Amazon, right? Now, Amazon is a US company, but assume for a moment Amazon India. Amazon India has a branch in US. Assuming Amazon India is an Indian company, it has a branch in US. Now that branch in US, when we say it is an integral part of the operation, means most of the things are controlled by the head office in India. Branch is acting at the full instruction of the head office in India. They are taking very few independent decisions. It is just like an extension of the company which is based in India. That is what is called an integral operation, foreign operation being integrated. What is non-integral? Non-integral is like an independent branch. They take their own decisions, they take their own purchase decisions, they take their own sales decision, credit decisions, whatever has to be done, they take it independently. They are very less dependent on the entity present in India. But if it is an integral operation, maybe that integral branch is just selling the goods supplied by head office to that particular location. Okay, so integral means as if they are the same or extended part of the entity which we are discussing about, right? Now, because it is an integral operation, individual transaction, how should we account for? As if they are entered by the entity itself. Meaning to say, had the entity entered into those transactions, what is the principle you would have applied? Exchange rate of that date of transaction. So using that rate itself, you will do the accounting for transaction. As far as fixed assets are concerned, whatever is the date of acquisition, or if you have done fair valuation under the revaluation model, on that, whatever is the rate on that date, you will use the exchange rate. Inventory, the date on which you incur the cost on inventory, or the date on which you value the inventory, that is the rate which you will consider. Any difference will go to P&L. Remember, differences arising on foreign exchange transactions should go to P&L. So for integral operations, if there are any differences which arise when you are translating those foreign currency transaction into the Indian accounts, in that case, whatever is the difference, that will be taken to P&L. So generally what happens in these cases is the foreign branch may prepare a trial balance. That trial balance, you will convert it into INR using these principles. And whatever is the exchange gain or loss, you will debit or credit to P&L. That is for integral operation. When it comes to non-integral operation, all the assets and liabilities will be converted using closing rate. So here you are using the transactions rates, the date existing on the date of transaction, or maybe you may using a weighted average rate. Here you will always use the closing rate. Income and expense, you will use the date of transaction, and whatever is the exchange difference which arises because of this translation, you will accumulate it in translation difference account. And what do we do with this translation difference account? When the foreign operation is disposed of, you will also transfer this amount to the reserves, right? So this is how you deal with integral operation and non-integral operations. Whether exchange gain is taxable as per the income tax? Yes, obviously, if you realize more amount, it will be taxable, right? Then a small discussion with respect to forward exchange contracts. For this also you need to understand an underlying concept. Say for example, in the case Infosys, when will Infosys receive that amount? Infosys will receive the amount on 30th of June from Amazon, $10,000, right? Infosys will receive this amount of $10,000 on 30th of June of 21. Now, does Infosys know what will be the exchange rate on that particular date? They will not know. Infosys will not know what will be the exchange rate on that particular date, correct? So, in such a situation, if Infosys does not want to, have any of this exchange rate risk, what it can do is it can take a forward contract. There is something called a forward contract. Now, what is a forward contract? Forward contract is basically a contract entered into today to exchange this foreign currency at a future date at a specified rate. So for this, we need to understand a few things. Spot, it is today's rate. Let us say today's rate in the market is 75. When the transaction happened, the rate is 75. Okay. In future, we do not know what will be the rate, but generally what happens is, because US dollar interest rates are lower, Indian interest rates are higher, also inflations are different, purchasing power parity is also different. Because of all of these reasons, don't worry, you'll understand this in CA final. The INR would depreciate against the US dollar. So if you see a trend, I was mentioning, right? I have seen this at 45 around in 2005, 6, 7, and 8. It went up to 62 in around 2015. So this was what was in 2000, let us say, 8 around. I don't know exactly the year. This was around 2015, and we are in 2021. It is 75. So over a long-term period, you will see that the Indian currency is depreciating. Now, Infosys wants to safeguard its position. So what it can do is it can enter into a forward contract. Forward contract means what? Contract to. Now, since Infosys will receive this $10,000, they have to sell this $10,000 after 6 months. So contract to sell $10,000. Contract to sell $10,000 on 30th of June of 21 at. Now, what could be the rate? The rate will be generally the higher one. Okay, so they will negotiate it with the bank or based on the market rate. Let us say the rate is 77. The rate is 77. Now, what happened here? Understand this transaction very carefully. You'll be able to understand the forward premium and amortization related concept. Today we sold at 10,000. The rate is 75. After 6 months, when I receive $10,000, I do not know what will be the rate. So today itself, I go to a bank and say, boss, after 6 months, I'll be receiving $10,000. I am selling this $10,000 to you after 6 months. You agree for a rate. Bank says, okay, we will buy at 77. Now, on the date of 30th June, exchange rate may be 100, exchange rate may be 50. This contract will be settled at 77. This contract will be settled at 77. Now this 77 is called the forward rate. This 77 is called the forward rate. Okay. Now the difference between forward rate and spot rate. See, there is also concept of cash rate, spot rate. I'll not get into all of that. Spot rate means today's rate. Just understand that. Okay. Difference between the forward rate and spot rate is called forward premium. Difference between the spot rate and the forward rate is called forward premium. Now it can be forward premium received or forward premium payable. It could be both of them, both the things, right? Now in our case, 77 is what we will receive versus 75 today. So 2 rupees is extra that we will be receiving for $1. That is called forward premium. And what do we do with this forward premium? Forward premium will be amortized over the period of contract. Now, what is the period of contract in our case? We sold the goods on 1st of January. 1st of January of 21 till 30th of June of 21. 6 months period, right? 3 months fall in the first period, first financial year, 3 months fall in the second financial year. So this forward premium in our case, which is at 77 minus 75, which is 2. This forward premium 1. So I'll just put a year here, 31st of March of 21. Okay, so 3 months period, half of it will go to this period, so which is 1, and balance 1 will go in the next period. So this is called amortization of forward premium. Now here I gave an example of a receipt. Similarly, there could be an example of payment. I do not want to take the risk and I enter into a forward contract with the banker or with another party. I agree for a higher rate. There is a forward premium payable. That forward premium payable will be amortized over the period of the contract. Amortized means what? This will be credited to P&L. Okay, in the respective period. If it is an outflow, if it is a payment, then it will be debited to the P&L over a period of the contract, right? This is what is called forward premium and the accounting treatment. Now, some of you may be wondering about how this will happen in the accounting aspect. Let me quickly, give those entries to you so that there is no confusion. On sale, what happens? Amazon account debit 75 multiplied by 10,000, 7,50,000 to sales 7,50,000. This is one thing that would happen. Okay. Ignore the restatement at the end of the financial year. That is already what we have understood. Now, when you enter into this transaction, what is happening? You are entitled to receive INR. You have to give the dollars and you are entitled to receive INR. Okay. So that INR, whatever you are entitled to receive, is after 6 months. What is the value today for that dollars? The value today for that dollars is 7,50,000. After 6 months, you will be receiving 7,70,000. This is after 6 months. But what is the value today? The value today is 7,50,000 only. The value today is 7,50,000 only. Okay. Now, after 6 months, when you receive this amount of 7,70,000, what do you need to give? You need to give them dollars. You need to give them dollars. How much of dollars do you need to give? You need to give them $10,000. The $10,000 worth today is 7,50,000. The $10,000 worth today is 7,50,000. So you have to give 75, $10,000 multiplied by 75. 750 is what is payable. You will receive receivable on that day will be 770, and the balance is forward premium, which is 770 minus 750. So debit, credit, credit. Now you may keep different nomenclatures when you're working, passing these entries. These entries will not be tested in the examination. I'm just showing you how these entries are passed. Now this forward premium of 20,000 will be transferred to the P&L over a period of 6 months. So 3 months, that is 10,000 will go in this period, 10,000 will go in the other period, right? This is the gist of accounting standard 11. Maybe we'll get some, get a chance to pick up a question from the past exam questions, if at all it has appeared, and we'll try to solve that as well. Okay. So what did we understand? Premium discount is amortized over the life of the contract. This is when it is not done for speculative and trading purpose. Now, what is this not done for speculative and trading purpose? The cases that we have seen. Here, the intention of the company is not to speculate. The intention of the company is not to trade. What is the intention of the company here? Intention of the company is to safeguard the cash flows. They would receive $10,000. They don't want variability in the cash flows. They are doing hedging. We call it hedging. But if it is done for speculative purpose, then all of this is not relevant. Forward premium amortization, discount amortization is not relevant. What happens in that case is you will do a mark to market at financial year end or at the time of settlement, and whatever is the exchange gain or loss on that transaction will be transferred to P&L. So instead of doing this settlement, let us say, instead of doing this today, what do? I feel the dollar will go up, so I'll buy dollar futures. Okay, there is another concept called forward. This concept is same like forward, but I as an individual may not be able to enter into a forward transaction with a bank. So what I would do is I would buy dollar futures in the market. Okay, now if I buy dollar futures in the market, let us say today's rate is 75. 31st March, the rate becomes 77. And let us say I bought $1,000, right? So if I bought $1,000, 77 minus 75, 2 rupee per dollar is my gain. So 2,000 will be gain credited to P&L. Okay. And let us say I sell it off on 30th of June at 78. Okay. So what is the gain now? 78 minus 77, 1 rupee is the gain. 1 multiplied by 1,000, this will be credited to P&L. So if I am holding it for speculative or trading purpose, then the difference between the rate of transaction and the closing rate or the settlement rate will be credited to P&L. Our study material has a problem where they have not done this MTM, but which is incorrect as per the standard. Also, as per the general practice, you have to do a mark to market. So whatever is the closing rate, at that rate, you have to calculate the gain or loss and credit or debit to the P&L. Okay. So this is with respect to foreign exchange. So now moving on to the next part. Again, a simple standard, a highly scoring standard, accounting standard 12 on accounting for government grants. Again, even in the standard, there are 2-3 simple principles that you need to remember. And once you remember them, you'll be able to solve the examination problem. And again, re-emphasizing that this kind, whatever is the question which is coming from an accounting standard, you should not be making silly mistakes and losing out on marks. I'm telling you, 20 marks can be straight away into your pocket, or at the most 16 to 18 marks will be straight away into your pocket if you master these accounting standards. Apart from that, obviously cash flow and investment accounting, different questions do come. But what is needed is, this gist of the, standards and not making those silly mistakes in the examination, right? Now coming to government grants. What are government grants? These are transfer of resources by the government to the entity. You set up some plant somewhere, government say, okay, we'll give you 10 crores. Or, you give employment to so many people, we'll give you some grant. Or you get some technology, we'll fund that technology. You build some plant in backward areas, we'll give you some funding and all of that. That is called government. Those are called government grants. Now, the key question which is dealt in by accounting standard 12, as far as accounting for government grants are concerned, is when should you recognize the government grant? When should you recognize the government grant? So 2 things have to be satisfied. There has to be an assurance, a reasonable assurance that the enterprise will comply with the conditions attached to the grant. See, nobody will give you grant for free, right? Even if your parents tell you that we'll get you an iPhone if you pass the exam, there is a condition attached. You pass the exam, you'll get your iPhone or get your bike or whatever it is. Okay. So for the company also, when the government is giving some amount, there are some conditions attached to it. And what are those conditions? There would be some conditions which the enterprise should comply with. That is the first thing. And secondly, there has to be an assurance that the grant will be received. See, if the government simply says we'll give you grant, but there is no assurance that the government will give us grant, then it is not a government grant. Okay. You can call it by the name of subsidy, you can call it by the name of grant, you can call it by the name of some amount given, whatever is the nature. These two conditions have to be satisfied. Conditions should be satisfied and grant should be received, and there is a reasonable assurance that these two things will happen. Now, once the recognition criteria is met, next is obviously accounting. Now, accounting can be bucketed into multiple aspects. One is non-monetary asset. Non-monetary asset given free of cost. We just now understood the example of non-monetary asset. If any non-monetary asset is given free of cost, then it has to be accounted for at nominal value. Say the government says, okay, you set up a plant here, I will give you, land. Set up a plant here, I'll give you land free of cost. So when there is no value attached to it, how will I pass the entry? I cannot say land account debit, capital reserve. What is the amount? So it says nominal value. Nominal value could be 1 rupee, 10 rupee, 100 rupee. Why should we record it? To show it in the balance sheet, show it in the face of the financial statements that land has been received free of cost. Land has been received free of cost. So that is one thing. Non-monetary asset, you will record it at nominal value. Okay. Then there could be monetary grants, actual financial resources being transferred. Now for this, we have to discuss under different heads. So one is with respect to depreciable asset. Now, what is this depreciable asset? How should we account for this? Option number 1, reduce it from the cost of asset. So let me just write entries for this. Cost of asset is 10,000. Okay. I'm purposely taking a lower number. Grant receivable or received is, let us say, 6,000. Two options. Option number 1, reduce it from the cost of asset. What is the meaning of that? The meaning of that is this grant should be credited to the asset account. So you will say to asset. How much? 6,000. Okay. Then what is the debit to? If grant is received, you will say bank account, or you would say grant receivable. How much? 6,000. Are you clear? Bank account to asset account. What is this entry for? Receipt of grant. Receipt of grant, 6,000, 6,000. Bank account debit, asset account credit. This is option number 1. What is option number 2? Can anybody tell me what is option number 2? You would have learned that and revised that by now. Sums will take it up from the exam questions actually to give you a feeling of how you can score those 20-25 marks. Example for depreciable and non-depreciable asset. Depreciable asset, plant and machinery. Non-depreciable asset, land. Land has an indefinite useful life. So depreciable asset. Deferred grant account or deferred income account. So you can set up a deferred income account. So you will say bank account debit 6,000 to deferred income or deferred grant account 6,000. Please write narration in the exam. I am not writing because I am not writing the exam. You have to write narration in the exam, otherwise marks will be deducted. I'm telling you. Okay, you will at least they'll deduct 1 to 2 marks for not writing narration. Right? So bank account debit to deferred grant account is the second option. Now, in the first option, what will happen? Fixed asset. Cost is 10,000. Cost is 10,000 less grant 6,000. Carrying amount will be 10,000 minus 6,000, 4,000. This amount will be depreciated over the life of that asset. So let us say useful life is 4 years. I'm making my life easier. Useful life is 4 years. Depreciation will be 4,000 by 4, 1,000. Every year you will charge depreciation of 1,000. So year 1 depreciation of 1,000, year 2 depreciation of 1,000. Let us say value at the end of year 2 is 4,000 minus 1,000 minus 1,000, 2,000. Okay. Value at the end of year 2 is 2,000 after charging 2 years of depreciation. Under deferred income, what will we do? Fixed asset. Cost 10,000. Useful life 4 years. Depreciation per year will be 10,000 by 4, 2,500. Every year you will transfer, or you will charge depreciation of 2,500. Then what do we do with this deferred grant account? Portion of depreciation, in the proportion of depreciation, you will transfer from deferred income account to other income. Now, what do we mean by in the proportion of depreciation? Here, depreciation is on a straight line method. So, amount to be transferred to other income will be 6,000 is the total income divided by 4. Every year you will transfer 1,500. What is the net impact? Depreciation debit 2,500, other income 1,500, right? Net impact 1,000, here also net impact 1,000. So net impact does not change. If you are using deferred grant approach on the basis of depreciation, generally the question will be on straight line method only. So you simply transfer this 1,500 every year to the profit and loss as other income, right? So the second option is deferred income and transfer to P&L on the basis of depreciation. Agreed? Okay. Then what if it is a non-depreciable asset? If the conditions to grant are already fulfilled, then you have to transfer it to capital reserve. If the conditions related to grant are already fulfilled, then you will transfer it to capital reserve. If conditions are not yet fulfilled, you have to fulfill those conditions in the future, and you will be incurring some expenditure to fulfill those conditions in the future. You will transfer it to deferred income, and again systematically on the basis of expenditure, you will transfer that amount from other income to from deferred income to other income. Okay. Then what do we do with grants related to revenue? Revenue means if it is not a grant related to asset, the company may say, the government may say, you give employment to 100 people, we'll give you grant. Or the company may say, you do this, development of this particular area, you do some expenditure on this, society, we'll give you some grant, right? You run a school, we'll give you grant. Now, something which is not related to an asset. If it is a grant related to revenue, then you will take it to deferred income. You will credit it to deferred income, and you will recognize it systematically over the period in which expenses are incurred to fulfill the condition. So let us say the government says you employ 100 employees, give them employment for 3 years, we'll give you government grant. Okay. What will you do? You will take that amount to deferred income. Now, to engage those 100 employees, you are incurring certain employee cost. In that proportion, you will transfer the amount from deferred income to the profit and loss as other income. Now, two presentations are possible: gross basis and net basis. You can show the expenses on gross basis and this amount as other income, or you can reduce this other income amount from the respective expenses, right? So in the proportion of the expenses that are being incurred, you will transfer the amount from deferred income to the other income account, right? So this is the broad treatment of government grant which are related to revenue or which are not related to asset. Then sometimes there may be a grant in relation to a promoter contribution. Promoter contribution means it is not specific to one asset. It may be to the undertaking as a whole without identifying specific assets. So we call those grant as grant in the nature of promoter's contribution. If grant is received in the nature of promoter's contribution, you will credit it to capital reserve. Okay. Then sometimes grant may be given to compensate past losses or financial loss. Let's say during COVID, government may come up with a policy and say that, okay, every company in this particular area, because of losses due to COVID, will give them, let us say, 1 lakh rupee, for example. Okay. Now this 1 lakh is not for future conditions to be satisfied. Conditions are already satisfied. There was a loss and the government gave us a grant. In such a case, you need not take it to deferred income because there are no conditions to be fulfilled in the future. Losses has already been incurred. They are giving it as a package that you can directly credit it to P&L, and you will treat them as extraordinary item if required as per AS5. If that fulfills the criteria of extraordinary item, generally it would be the case, you will recognize that item as an extraordinary item as per AS5. But in a nutshell, if it is in relation to a depreciable asset, reduce from the cost of asset or take it to this deferred income account. Otherwise, if it is for non-depreciable asset, either to capital reserve or to deferred income. If it is in relation to revenue, defer the income and recognize it over the period in which you will incur the expense. Now, what if the conditions have been already satisfied? What if the government comes and says, because you had employed 100 employees in the last 3 years, we are giving you grant. There are no future conditions attached. Then you will take it to P&L directly. Promoters contribution, capital reserve, and past losses and financial losses credited to P&L. Simple standard, just keep you calm and better the examination. You will score 5 out of 5. Definitely, this is my guarantee, right? Now, you had some conditions. The conditions were not satisfied. What will you do? Your parent give you an iPhone saying that you scored 60+ in accounts, and you did not score 60+ in accounts. They will take back the iPhone. Same thing. Government has given you grant. You don't fulfill the conditions. Government will take back the grant. Now, what to do when the government takes back the grant? Simple. What did you do when the government gave you grant? I reduced from the cost of asset. Okay, add it back to the cost of asset. No. I credited it to deferred income account. Debit it to deferred income account. No, I had credited to capital reserve. Debited to capital reserve. Sir, but there is no balance left in deferred income account. Debited to P&L. Simple, right? Whatever was the treatment given earlier, you have to reverse that. So, for example, the reason why I said 2 years, value at the end of year 2 is 2000, and the government says, I gave you a grant so that you can do something. You did not do those things. Please give back the grant. What was the grant amount? 6,000. Okay, add grant refunded 6,000. Then carrying amount, how much? 6,000 plus 2,000, 8,000. What is the balance useful life? 2 years, depreciated over remaining 2 years. In this case, over a period of 2 years, amount transferred to other income will be 3,000. Correct? What is the balance left in deferred grant account now? 6,000 is what we received. 3,000 you have transferred to other income. So this balance is 3,000. So what will you do? Debit deferred grant 3,000, and we have to refund 6,000. Balance debit P&L. Just reverse the impact that you had taken or that you had given earlier. As simple as that. Okay. So this concludes government grant. Let me see if you have some questions here. No questions. Okay. So moving on, accounting standard 13. I will keep accounting standard 13 discussion brief because there is a separate chapter on this, and concepts I'll definitely cover it here. And based on this concept, you should be able to solve the questions on this chapter. Accounting standard 16 is where we will be spending a good amount of time, and then we'll take up a past exam paper. Okay. Accounting for investments. What are investments? Investments are assets held by enterprise for earning income. So these are assets held by enterprise to earn income. How? Dividends. They would get dividends, or they would get interest, or they would get rentals. When I say dividend, maybe they have acquired shares. When I say interest, maybe they have invested in some bonds or some debentures of any company. When I say rentals, maybe they have purchased an investment property. Okay. So these are the assets. Again, AS2 also we talked about assets. AS10 also we talked about assets. Even AS13 is about assets. If they are held for earning income by way of rentals, then we call them investment. Okay. That is one thing we need to understand. Or if not for income, for capital appreciation. I purchase shares of a company. The company doesn't pay me dividend, but after 5 years, maybe the share value will be double or triple, maybe possible, right? So then that is also called as investment. And for other benefits to the investing enterprise. So some other benefits, may not be capital appreciation, maybe some other benefits for the investing enterprise that the entity which is investing is making. Okay. Assets held as stock in trade are not investments. So what is the meaning of this? Say there is a builder. The builder has a lot of buildings, but those buildings are inventory. When those buildings are inventory, can I classify them as investment as per AS13? No, I cannot classify them, right? They would not be investment because they are inventories. Similarly, if I keep on purchasing and selling shares as a business, I purchase in the morning, I sell in the evening, purchase today, sell tomorrow, I treat it as a trading activity, then it is not considered to be an investment. Okay, because it's considered to be a stock in trade, right? So this is the gist of the definition of investment. Then there are two types, current and long term. This is one aspect which gets tested quite often in the examination. What is current? Current means it is readily realizable and not intended for more than 1 year. you want to sell it off within 1 year, then it is current. Otherwise, it is long term. If it is current, you will value it at lower of cost or fair value. You will value it at lower of cost or fair value. Difference will go to P&L. Difference will go to P&L. I think I wrote a mistake. Maybe I was copying that. This is also P&L. Okay. Maybe I was copying this chart earlier, so an error there. Sorry. Yeah. Then long term, which is other than current, it is always carried at cost. General principle: current investments lower of cost or fair value. Long term investments always at cost. Then what is the exception? If there is a decline other than temporary, so there has been a continuous decline in the value of investment and it is not a temporary decline, then you will bring it down to its fair value, and in that case the difference will be taken to P&L. Okay. Now, as far as costs are concerned, how do we calculate cost? You will take the acquisition cost, that is the cost that you pay to acquire that particular investment. Brokerage, please remember brokerage, when you sell also there will be brokerage. So brokerage is given as percentage. Let us say brokerage is 2%. This is always on transaction value, not on face value or par value. You will receive dividend on face value. The brokerage is always paid on transaction value. So if you buy something at, let us say 150, brokerage will be 150 multiplied by 2%, which is 3. So your cost will be 150 plus 3, 153. If you sell at 150, you will pay brokerage of 2%. Sometimes in the exam they give a different buying commission and selling, buying brokerage and selling brokerage. Okay, 3. So what is your say? Net sale value? Net sale value will be 150 minus 3. 147. I've seen students making mistakes here. Even while selling, they'll add brokerage to the sale value and you will lose marks. Okay, so buying brokerage will be deducted. Buying brokerage will be added. Selling brokerage will be deducted from the proceeds. Okay, so what does cost include? Acquisition cost, brokerage, any other duties which are paid. Okay, so this is the concept of cost. If securities are issued to acquire investment, then you will take the fair value of the investment. If other assets are given up, then fair value of asset given up or acquired, whichever is more evident. Okay, so if shares and securities are issued, you will do the fair value of investment, that is the investment that you have acquired. If other assets are given up, then fair value of the asset given up or fair value of asset acquired, whichever is more evident. Now don't confuse this with the exchange transaction in AS 16, AS 10. Okay, AS 10, property, plant and equipment, that has a specific requirement of considering the fair value of asset given up, whereas here fair value of asset given up or acquired, whichever is more evident, whichever is more clear, whichever you are more comfortable with, that is the value you would be taking. Okay, and if at all there are pre-acquisition dividend or interest, you will reduce it from the cost. Now here again there is one concept called cum interest and ex interest. Okay, cum interest means cumulative of interest, ex interest means excluding interest. Now whenever you do investment accounting, in the investment portion, you will always take excluding interest value. You will always take excluding interest value. Now why would this kind of confusion arise? Say for example, you purchased a security on 1st of September of 21. On 1st of September of 21, you purchased something which has a face value of 100. Okay, and it has an interest rate of, let us say 10%, I'll make it 12%, right? And interest is due. Interest is due on 30th of June and 30th of December, right? You purchased on 1st of September. When did you purchase? 1st of September. When was the last interest paid? 30th of June. Now, someone who is selling you this particular investment, will he just sell you at 100? No, he will also say 100 is the value of this investment. I'm taking 100 for simplistic reason. The value of investment may be 102, 103. It could be premium discount. We are ignoring all of that. Let us assume value of the investment as such is 100, and on top of it, for July and August, here is again one mistake what students do. If it is given 1st of September and here 30th of June, June, July, August, September, don't take it 4 months. 30th of June, so start from July and August, 2 months. What is 2 months interest? 100 multiplied by 12% divided by 12 multiplied by 2, you get 2 rupees. So total amount that you will pay is 102. This is called value. It's called cum interest value, cum interest quote. Okay. Now you paid 102. Why did you pay 102? You paid 102, 100 towards principal or face value or investment cost, 2 towards the interest portion, right? So you'll split that and you will account the investment at 100, and this 2 will be considered as interest receivable. So the entry would be investment account debit, which is 100, interest receivable debit, which will be 2, and to bank, which will be 102. This you will show in the income column in the investment account if required, and this will be shown in the cost column of the investment account. You will always value it at X interest, and if there are pre-acquisition dividend or interest, in our case I took an example of interest, there could be a pre-acquisition dividend as well. Okay, those are reduced from the amount that you are paying for acquiring that particular investment. Okay, then we have the thing of rights issue. What happens in the case of rights issue? If subscribed, normally if you are buying an investment, same treatment. If entitlements are sold, so you have rights, you have entitlement to subscribe to the rights, but you did not subscribe to the rights, but you sold those rights. In that case, whatever proceeds are realized, you will credit it to the P&L. And if investments are acquired on cum right basis, so you purchase some investments on cum right basis, right? And the price falls after the rights issue. So I bought on a cum right basis, and the rights issue happened, and after the rights issue it falls down. In that case, you may reduce the sale proceeds from the carrying amount, because the price has fallen because of the rights issue, and I have purchased the shares on a cum right basis. This is only when there is a right issue which is pending. You cannot do this if you have already purchased it 2 years back, and today the company has come up with rights issue and there is a fall in the value of rights. You cannot, reduce the sale proceeds from the cost of that rights or cost of the share. You have to credit that to P&L. This is done only when they are acquired on a cum right basis, means rights issue have been announced by the company, right? This is about investment accounting in a nutshell. Now let us move on to the next aspect of disposal. So whenever there is a disposal of investment, difference between the proceeds and carrying amount will be credited to the P&L. You will use weighted average basis of computation. You will not use first in, first out. You will use weighted average. Reclassification, current to long term, lower of cost of fair value, long term to current, lower of cost of carrying amount. Now when you are classifying an asset, when it was a current asset and now it has become a long term investment, then you will see what is the cost, what is the fair value, whatever is the lower of the two amount, at that value you will reclassify them as long term investment. Okay, and if you are reclassifying something from long term to current, you will see what was the cost, what is the carrying amount, whichever is less, at that value you will reclassify them as current investments. Now moving on to borrowing cost. Let me check if you have some questions. If date is given in middle of the month, how to calculate? You may use number of days to calculate that. Generally, they will not give it, but if they give it, you can use the number of days. Pre and post acquisition dividend. So, pre and post acquisition dividend. For example, let us say you purchase some shares on 1st of April. Okay, 1st of April, and the company declared some dividend on 30th of June of 21 for the financial year 2020-2021. Okay, so when did you purchase? You purchased here. When did the dividend come? Dividend come in on 30th. The dividend was declared on 30th of June. When is that dividend pertaining to? It is pertaining to this particular financial year. Then in that case, from this cost, whatever you have paid, you can reduce the dividend amount. You can reduce the dividend amount because dividend is pertaining to a period before acquisition. Okay. Now coming to borrowing cost, again a simple standard which talks about capitalization of borrowing cost. It talks about capitalization of borrowing cost. Very simple concept. Okay. It requires is either you may get a theory question which asks you about what is a qualifying asset, not a qualifying asset, can be capitalized, can not capitalized, or calculate the amount of borrowing cost to be capitalized. What is borrowing cost? Cost incurred for borrowing. If you have borrowed some amount, if you have incurred certain cost, that is called borrowing cost. Okay. Now here, this is very important. Okay. Here you may get confused slightly. We'll discuss this with an example. But apart from that, borrowing cost includes interest and other commitment charges on borrowing. So whatever interest you are paying, that is a borrowing cost. If there are any discount and premiums related to borrowing, then also it's a borrowing cost. What does that mean? You have issued, let us say, 100 rupees worth of debentures at 95. So you got 5 rupees less. That 5 also forms part of borrowing cost, and you have to amortize that over the life of the debenture. Okay. Similarly, if you are repaying a borrowing, if you are repaying a debenture at a premium, that premium is also a cost that also has to be amortized over the life of the borrowing. Then any other cost incurred in connection with arrangement of borrowing, you may pay some processing fees, you may pay some consultancy charges, legal charges. All of the costs which are associated with borrowings are called borrowing costs. Okay. And if you have acquired an asset under finance lease, you'll understand that in group 2 AS19, finance charges in relation to these assets are also called as borrowing cost. Now, what do we do with this borrowing cost? Borrowing cost, if it is in relation to a qualifying asset, then you will capitalize. Otherwise, you will expense. That is the treatment. And one aspect, what I told you in the beginning, exchange difference arising from borrowing, foreign currency borrowings, to the extent they are regarded as adjustment to interest cost, even these are called as borrowing cost. Now, how do we calculate that? Let us take an example. Generally, as I told you, interest rates in foreign countries, let's say interest rates in US, they are generally less. Okay, so today also, if you want to go and let's say borrow in USD, you may get at 3%. I'm telling you, 2% to 3%, 1%. In fact, we have done transaction at 1.5% also, right? I'm not sure of the exact rate, but assume you get it for 3%. Okay, rates are generally lower than in the developing countries. And what is the rate here? Interest rate in India is 7%. Okay, now you get a wonderful business idea. I will borrow in USD, lend money in India, I'll pay 3% interest there, 7% interest I'll earn, and I'll make a lot of money. Friends, it is not so simple. What happens is, as we have seen in the case of exchange rate, because of this interest rate parity, so there is a theory called interest rate parity theory. Based on that, because there is an interest rate differential and there is an arbitrage opportunity, you can borrow in US and you can lend in India and you can make 4%. If it is so easy to make money, everybody would jump into this business and they would make a killing out of it. But it is not so simple. What would happen is, interest rate will go from, interest rate differences is there. But from the time you borrowed the foreign currency loan to the time you repay the loan, you have to pay an additional amount by way of exchange difference. Remember, let us assume date of loan is 1st April of 21. Date of loan is 1st April of 21. Amount of loan is, let us say, $10,000. Amount of loan is $10,000. Exchange rate on the date of borrowing is say 70. Okay, and for a moment resume exchange rate on 31st of March of 22, that is after 1 year, maybe settled or maybe unsettled. It is 75. Exchange rate is 75. Okay, now what happens here? How much is the exchange loss? You borrowed something at 70 and now you have to pay 75. You have to pay 75. What is the exchange loss? Exchange loss is 75 minus 75 rupee per dollar multiplied by $10,000. You have an exchange loss of 50,000. You have an exchange loss of 50,000. Now, what is the interest you have to pay in USD? You have to pay 3%. You have to pay 3%. On what amount? $10,000. So I'll just type it here. $10,000 multiplied by 3% multiplied by you have to pay 75. Okay, provision or payment, whatever it is. So how much is that? 10,000 multiplied by 3% multiplied by 75. That comes to 22,500. 22,500 is the interest you will pay on the USD loan. Now, what the standard wants to do is, what would have been the interest had you borrowed in India for equivalent amount? Now, what is the amount we borrowed? We borrowed $10,000. $10,000 we borrowed when the rate was 70. So in Indian terms, we actually borrowed 7 lakhs multiplied by 11%. Oh, sorry, 7%. How much is this? 10,000 multiplied by 70 multiplied by 7%, 49,000. So because of my borrowing in US, I have saved interest. I would have paid 49,000 in India. I'm actually paying only 22,500. What is the savings in interest? Savings in interest is 49,000 minus 22,500, which is 49,000 minus 22,500. I saved 26,500 on interest, but I paid 50,000 extra by way of exchange loss. I paid 50,000 extra by way of exchange loss. Now, what the standard says is, whatever is this exchange loss, out of that, how much is compensating your savings in interest? Sir, 26,500. This you treat it as borrowing cost. I'm repeating. Out of the exchange loss, how much is the savings in interest that is being compensated? Entire 26,500. So 50,000 out of 50,000 of loss. Compensation for interest is 26,500. Balance exchange loss, which you can consider for AS11 purpose, is 50,000 minus 26,500, which is 23,500. Are we clear? Now, what if, I'm just changing the example, exchange rate instead of being 75 was 72. Exchange rate instead of being 75 was 72. What is the exchange loss? 20,000. What is the savings in interest? 26,500. Now, this entire 20,000, in the second case, the entire 20,000. So here you will not say 26,500, you will say 20,000 is compensation for interest. There is no balance exchange loss for AS11. So you will not take anything to AS11. First, you will apply AS16. To the extent of savings in interest, you will, treat it as a borrowing cost, and balance will go to the balance will go for treatment under AS11. So the formula could be lower of exchange loss and savings in interest. This you will consider as a borrowing cost. Please note this down. Lower of exchange loss and savings in interest, whichever is less, that to that extent will be treated as borrowing cost. Under which principle? Under this last principle. Exchange differences arising from foreign currency borrowings, to the extent that they are regarded as adjustment to interest cost, that will be considered as borrowing cost. Okay, this is all about borrowing cost. Now, what do? Borrowing costs which are attributable to acquisition, construction, or production of a qualifying asset should be capitalized. Remaining will be expensed. Okay. What is qualifying asset? Which necessarily takes a substantial period of time to get ready for its intended use or sale. Intended use covers accounting standard 10 property, plant and equipment, covers intangible assets accounting standard 26. For sale covers accounting standard 2 inventory. So if there is a qualifying asset which takes substantial period of time, then to that asset you can capitalize borrowing cost. What is substantial period of time? Presumption 12 months or more, unless you can justify it otherwise. So there's a presumption. Sometimes the period may be longer, sometimes the period may be shorter. It is purely on the call of the entity, right? Then how do you compute? If there is a specific borrowing, what is the meaning of specific borrowing? I am constructing a building. For that building, I have taken a loan, and that loan amount, I am using it for the purpose of the building. So I can identify this loan is going for this particular building. That is called specific borrowing. If it is a specific borrowing, you will take actual borrowing cost less income on temporary investment. So sometimes what happens is you may not be utilizing the full amount of borrowing. You may have invested it somewhere temporarily. Then in that case, investment income will be reduced, and actual borrowing cost, which is incurred minus temporary investment income, will be capitalized. Okay, that is the part related to specific borrowing. If it is a general borrowing, the LTD has multiple different borrowings. They have issued debentures, they have taken bank overdrafts, they have taken term loan. You cannot identify which loan is taken for which asset. Then you will calculate a capitalization rate. What is this capitalization rate? Weighted average interest rate. What is this? Weighted average interest rate. And based on the amount of expenditure, you will apply this capitalization rate and you will compute the amount of borrowing cost to be capitalized. Okay, that is the second aspect. Now, sometimes in a question, they may give you specific borrowings as well as general borrowings. So we can assume that specific borrowing was applied first, and then you can take the rate related to general borrowing. Okay, when should we start capitalization? Three conditions: expenditure is being incurred, borrowing costs are being incurred, and activities are under progress. If these three conditions are satisfied, then you can capitalize the borrowing cost. When do you suspend? During extended periods when active development is interrupted. Meaning to say, let us say there is a qualifying asset, but because of some unforeseen reason, there is no activity which is happening. These activities are not under progress. Why? Maybe because of labor strike, maybe because of material shortage. It was not available. Now you see, right, chip shortage happening, coal shortage happening, unknown, abnormal things which were not anticipated. Then in that case, if active development is interrupted, then you will suspend the capitalization. So this happens, in case where there is an inordinate delay which was not anticipated earlier. But if the delay is a normal part of the project, bridge is being constructed and you know that the water levels will keep on rising, in that case, is it not a part of the construction process itself? Was it not known that during few months of monsoon, the bridge water level would rise and you will not be able to do construction during that period? If that is the case, then you will not suspend because it is a part of the project. Okay, cessation, when do you stop? Where substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are completed. So once the building is ready, let's say building, we are talking case of building is ready for its intended use and sale, then you can stop the capitalization of borrowing cost. Building is completed, you have not yet installed the call bill. Does it mean you cannot capitalize? You have to. Does it mean you can continue to capitalize borrowing cost? No, just that call bill is remaining, right? Substantially the building is ready, stop capitalization of borrowing cost. Or some puja has to be done, some murat has to be found out. Those are all decorative things, those are all ancillary things. Is the building ready for its use? Yes, then stop the capitalization. Okay, you have to check it on part to part basis. So let us say a project has 5 blocks, 3 blocks are completed, 2 blocks are under progress. For those 3 blocks which are completed, you will not capitalize borrowing cost, right? So with this, we have quickly revised the balance 4 standards, and now it is time to take up a past examination question paper. If you have any doubts, I would be happy to help you. Just let me know. Maximum period for substantial period, there is no maximum period. Reclassification. Okay. Reclassification means you had acquired an investment and it was a current investment, but later on you changed your mind and you converted it into a long-term investment. Then when you are reclassifying, what should be the amount you should recognize in the balance sheet? Lower of cost or fair value. Lower of cost or fair value. This is the same principle you apply to value current investments. Second, long term to current, lower of cost or carrying amount. Lower of cost or carrying amount. So from long term to current, if you are doing, you will check what is the cost and what is the carrying amount. See, when you value long term assets, you will always value at cost, or else if there is a decline, then you will reduce the value. So what is the carrying amount? You will see the carrying amount is, let us say, 100. Cost is 120. Lower of this to 100. That is the value at which you will recognize the current investment. Okay. So let me just pick up a past exam paper and help you understand how to you handle the questions in the examination, right? So let's take up the July paper. Okay. Right. So if you see, question number 1 is compulsory. A, inventory. exactly the same concept what we discussed yesterday. Replacement of the cost or replacement cost basis and all of these things, right? So we'll do the computation and we'll see, right? Then or we'll take up question by question and then we'll solve it one by one. So don't get concerned with the length of the question. Sometimes the question may be lengthy, but you will be able to score full marks. You will be able to score full marks. Please focus on that. Joy Limited purchased 20,000 kilograms of raw material at 20. Joy Limited purchased 20,000 kilograms of raw material at 20 during the year 2021. Okay, they have furnished the following information. Opening inventory, finished goods 2,000, raw material 2,200, direct label 3,06,000, fixed overheads 3 lakhs, sales 20,000. Sale amount is not relevant unless we have to calculate the compare it with the cost of finished goods. Closing inventory, finished goods 2,400, raw material 1,800. The plant has capacity to produce 30,000 units. Now, why is this 30,000 unit relevant? To calculate the overhead recovery rate. We understood yesterday, the total overhead divided by the normal capacity will give you the overhead recovery rate. However, the actual production during the year 2021 was only 20,400. So actual production also has been given. See, you can calculate using this also. Opening inventory or sales plus closing inventory minus opening inventory is 20,400, right? So that is given directly in the question. Due to fall in market demand, price of the finished goods in which the raw material has been utilized is expected to be sold at 40. Here, 20,000 units are being sold at 11,20,000. So that comes to about 55, 56 change, right? 55 or something change. Whereas, because of the fall in market demand, now it will be sold only at 40, and the replacement cost of raw material was 19 per kilogram. When we purchased, it was 20 per kilogram. Now it is 19. You are required to ascertain the value of closing inventory as on 31st of March as per H2. Now, when I've corrected these kind of questions in the past, I've seen students, whenever the question asks value the closing inventory, they'll only value finished goods or they'll only value raw material. When they say finished value inventory, you have to value both finished goods and raw material. You have to value both finished goods and raw material. Now it's a very simple thing here. How much has been produced? 20,400 units have been produced. This is reconciled by looking at it. What is the value of closing inventory of finished goods and raw material? That is what we need to explain and determine, right? So now here, what is the raw material cost? Raw material cost is $20 per kilogram. Okay. And in the past also they have been purchased at 2,200 into 20. So no complication there as well. Okay. Direct labor is 3,06,000. You can add here total. You not add also. You will see the presentation. This multiplied by 20,400. Okay, that is what is produced. Direct labor. What is the direct labor? 3,06,000. So if it is 3,06,000, how much it is per unit? This divided by 20,400. This is the production. Okay. Okay. Then overheads. How much is the overhead incurred? Now you cannot absorb everything in the production because you have to calculate fixed overhead recovery rate. So overhead recovery rate is equal to 3 lakhs divided by 30,000. How much is that? That is 10 per unit. So here fixed overhead will be 10 per unit. So this multiplied by 2,400. Total column need not be mentioned. I'm just writing here for your understanding. Okay, 10. Right? Are there any other costs? There are no other costs. So what is the cost of inventory? Finished goods. Cost of finished goods is 45. What does the question say? Finished goods will be sold at 40. So are there any selling expenses given? No selling expenses. So sale value is 40. So what do you value? How do you value finished goods? Finished goods are valued at lower of cost or net realizable value. In this case, NRV is 40, which is less than cost. Hence, finished goods will be valued at 40. What is the value of finished goods? Value of finished goods will be number of units of finished goods, which is 2400 multiplied by 40. Okay, at NRV. At cost. Cost will be 2400 multiplied by 45. So that will be 2400 multiplied by 40 and 2400 multiplied by 45. Okay, so NRV is lesser, so it will be valued at 96,000. Now, value of raw material. If the finished goods, yesterday we discussed, right? If finished goods in which the raw material is incorporated will be sold below cost, then you will value the raw material at replacement cost. So, basis why? Because raw material finished goods is sold at less than cost, right? So, what is the raw material? 1800 multiplied by replacement cost is 19. Cost basis 1800 multiplied by 20. If it was on cost basis, 1800 multiplied by 19, that gives you 34,200. 1800 multiplied by 20 will give you 36,000. So, value of inventory will be 34,200 plus 96,000, 1,30,200, right? So this is how you can approach it in the examination. Okay, so let's see how it's been presented in the solution. Cost 45, right? So see, they have done it using aggregate and then divided it by number of units. You can present it in tabular format also, no problem. Since the net realizable value is less than cost, closing inventory will be valued at 40. Okay, then value of closing raw materials as NRV of finished goods is less than its cost. The relevant raw material will be valued at its replacement cost, which is at 19, and the closing inventory is 130. They have done this reconciliation. You can also do it in the examination. Okay, which may not be really relevant in this question because the question itself has said, 20,400, but it is good that you check it in the examination. Otherwise, if there is any balance figure, there may be a mistake. So we can add that. Raw material consumed. You will apply the concept of costing. What is that? Opening raw material plus purchases minus closing raw material. There is more for reconciliation. What is opening? 2,200. Purchases 20. Closing 18. So 2,200 plus 20 minus 1,800. That gives you 20,400, which is the consumption that we have considered while calculating this. Okay. It is clear from the question that 1 unit is used to manufacture 1 unit of finished goods. Now, go back and check IPCC questions or CA inter questions. You will see that this kind of question is appearing in the examination every alternate attempt. Almost every alternate attempt. I don't know what was asked in January 21. Let me just open this, and also let me open November. Machinery security. See, just now we discussed. They want to reclassify its investment long term to short term. 5 marks question. See, gives the following information of inventory, replacement cost, purchase price is given, finished goods is produced. This is the this units can be finished by incurring additional cost. So that will help you to calculate the net realizable value. Expected selling price is 280, subject to a payment of 5% of brokerage on selling price. Brokerage on selling price you will reduce. Then determine how you will calculate the inventory and calculate the value of inventory. Same concept, similar concepts that we have done. Same way it is being asked in this, asked in the examination. So this is a single concept which is tested again and again from accounting standard 2. Let us look at what was asked in January, or was this November? I don't know. grant, investment in shares, and this is the one related to borrowing cost. So here it was not asked, but generally if you see concept, this is the concept that will be tested. Okay, let's move ahead. This is in relation to AS10, a very straightforward question. A Limited has contracted with the supplier to purchase machinery which is to be installed at its new plant and machinery. Okay, special foundations were required. Okay, the cost of site preparation and laying foundation was this. Cost of site preparation and laying foundation, will it be included as a part of cost of fixed property, plant and equipment? Yes, because these are incurred for getting that PPE into its current condition and location. Activities were supervised by an architect during the entire period who is employed for this purpose for a salary of 3,500 per month, 35,000 per month. Again, can be, you can make a mistake in the examination here. 35,000 per month. How many months? 4 months. We'll take only 4 months period. Okay, just don't take 35,000 and be done with it. Machinery was purchased for 1,27,50,000. Okay, this was incurred on transportation, that will be included. Engineer was appointed at a fees of 37,500 to supervise the installation of the machinery at the plant site. Will you include that? Yes. You are required to ascertain the amount at which machinery should be capitalized in the books of A Limited. So here you have to say that all the costs which are incurred to bring that property, plant and equipment in the condition and location to be operated in the manner as intended by the management, those costs will be capitalized, and then you can just include all of these costs. Okay. Second question. It's there in the study material also. B Limited, which operates major chain of retail stores, has acquired a new store. New location requires substantial renovation expenditure. Now, this renovation expenditure, if they are necessary to bring that store in the condition and location as intended by the management, will capitalize. Okay. Management expects that it will last for 4 months, during which the store will be closed. Management has prepared the budget for this period, including expenditure related to construction and remodeling, salary to the staff before its opening and related utility costs. How would such expenditure be treated in the books of B Limited? So if they are necessary to bring the store to the current condition and location, the remodeling and reconstruction will be capitalized. But if those employees cost and all of that represents either time of employees which should anyways have been incurred, it is not specifically in relation to this particular store, then it will not capitalize. Yet both the arguments can be given. Received the following grants during the year ended 31st March. 120 lakhs received subsidy from the central government for setting up an industrial undertaking in a notified backward area. Grant in the nature of promoter's contribution. Credit to capital reserve. 15 lakhs from central government on installation of effluent treatment plant. Grants related to depreciable asset. Either reduce it from the cost or take it to deferred income. 25 from state government for providing medical facilities to its workmen during the pandemic. Okay, so already the expenses have been incurred. You can credit it to the P&L, or if you believe that the pandemic is still going on and they have to continuously provide, then you can set up a deferred grant account. See, such simple questions in the examination, 5 marks. You cannot lose marks in these kind of questions, right? Cash flow, it's a straightforward question. They are given a cash summary account. You have to prepare a cash flow statement. Just need to pick up the correct amount and place it at the respective places. It is done, right? And let us look at this. On 15th April, they obtained a term loan from bank of 320 lakhs to be utilized as under construction of factory set. Assuming now, in this case, you always write an answer saying that it is assuming that this factory shed construction is a qualifying asset. Then you will capitalize. Purchase of machinery. Generally, if it is an outright purchase, it will not be a qualifying asset, so you will not capitalize. Working capital is definitely not capitalized. Purchase of vehicles, again, ready for use, will not be capitalized. Advance for tools, cranes, and purchase of technical know-how. So, depending on whether you treat this as qualifying asset or not, accordingly, you will categorize this as capitalization or not required to be capitalized, right? Purchase of technical know-how, already ready to use, right? So there is nothing to be capitalized in that context. Okay. So again, 6 items. 6 items, you get 5 marks for correct explanation. Now, in these kind of questions, the advantage with you is even if you are confused in some cases, even if you are able to write 3 or 4 answers correctly, you will get 3 to 4 marks. You should not be losing marks in the accounting standard related questions. Question on investment. Question on government grant, question on depreciable assets. Okay. Right? Any more questions if you have in relation to accounting standards that we have been discussing for group 1, please let me know. I'll be happy to take that. Otherwise, we'll call the session, and we'll see if we can plan accounting standards for group 2. We'll let you know. You can keep following the app on that. So accounting standard 12 talks about government grant only. That is, you have to receive it from the government, the central government, or the state government, or the government authorities. Other grants are not covered by this. Now, let us say they have received grant from some other company. Then, okay, if the grant has been received, you may reduce it from the cost of those respective assets and present it in the balance sheet. You may apply similar principles, but that will not be covered by AS12. Why not to capitalize purchase? Why not to capitalize purchase of machine? Because machine is in a ready to use condition. See, qualifying assets are those assets which take substantial period of time to get ready for their intended use or sale. Now, if you're buying a machine, the machine is already ready. Had the machine taken 2 years to be constructed and you are giving advance for that machine, then it can be called a qualifying asset. Otherwise, you'll not call it a qualifying asset. MTP problems also would be similar. If you want, see, I have some 10-15 minutes. I can take up a couple of questions from some more past exam papers. Let me just share the screen. Okay, so and just randomly I'll pick up some paper, maybe November 19 paper. We can have a look. Older questions are not there. I can and see. Prepare cash flow from investing activities. Only investing activities. You need to identify what are investing activities and prepare. I don't think it is very difficult to prepare cash flow from investing activities in such a case. Okay. Then head office in Mangalore has a branch in US. Trial balance is given. Prepare trial balance after being converted into Indian rupees in accordance with AS11. Okay. So here goods have been sent by head office and all of that. So you can assume this to be an integral operation and then do it as per the accounting for branches question. Then inventory, again, same question. 2 years back also same question. They just changed the numbers. They just changed the numbers and similar questions are asked. This is for deferred taxation, which was earlier there in group 1. Now it is not there in group 1. So, you can. I think machinery I gave the response to. Group 2S will get to know. We'll announce a date on that if feasible in the next over a period of 1 to a week, 10 days. We'll do it. Deferred tax is a part of group 2, will not be considered here. Let us go back to some older questions. Institute doesn't have them here. You can have it on our website. You can just go to indigoloan.com and you can download it. See, I have tried my best to cover the standards in summary in revision form. If you are still finding it, difficult to understand some critical concepts, we have this individual accounting standards module sale available. You can take the benefit of that at 199 rupees by using ICAS. It will come to around 150, 160. You can spend a couple of hours and master that particular standard. Right, accounting standard 20 is fully available for free on our YouTube channel. You can make use of that. And past exam papers, you can download it from here. So let us look at some previous year papers prior to 2019 that is not available in the institute website. So May 18 paper, if you have a look at it, let me just sign in. Okay, so May 18 paper. Let us see what was the On 1st April, XYZ Limited received a government grant of 100 lakhs for an acquisition of new machinery costing 500 lakhs. The grant was received and credited to the cost of the assets. The lifespan of the machinery is 5 years. Machinery is depreciated at 20% WDV. Now, this question is slightly incorrect because if it is a WDV method, 20% rate of depreciation would not be appropriate unless we assume that at the end of 5 years, the residual value will be so much. Okay. Company had to refund the grant on 2nd April 2017. So on 1st April 14, you have received due to non-fulfillment conditions. How would you deal with the refund of the grant? Now, in these kind of question, what you need to do is you have to first explain You have to first explain the theory, because the question says, how do you deal? So you explain the theory, how do you deal, and then give the working. So at the time of acquisition, you would have reduced it from the cost of the machinery. So 500 lakhs minus 100 lakhs, 400 lakhs, you would have reduced it from the cost of machinery if you have assumed that the question itself says it is received and credited to the cost of asset. So 400 lakh is the cost of asset. 20% depreciation for first year. So 400 multiplied by 20% makes it 80 lakhs for the first year. In the second year, it will be 64 lakhs. How 64? Because 80 into 80%, 64. Then 64 into 1st April 14. So 31st March 15, 31st March 16, and 31st March 17. You have to calculate depreciation for 3 years. 80 multiplied by 80%, 64. 64 multiplied by 80%, 51.2. This is the book value. Then you refunded the grant. You will add back the refund. Revised book value 304. Now on this, 20% will be charged as depreciation for the next 2 years. Okay. Obviously, you'll have to go back and check the residual value, carrying amount, and all of those things as per AS10. That is fine. But as far as AS12 is concerned, this is how you present the answer. Now, this concept and there is a straightforward 5 marks just given to you on the platter. Nothing complicated. Okay. Then ABC Limited borrowed 500,000 on 1st July of 17, which was repaid on 31st July of 17. So 1 month. ABC prepares its financial statement on 31st March 17. No. So this is not July. This is 1st January. Oh, okay. So one more thing, in examination, sometimes you'll get these kind of errors. So you have to look at the question carefully and make an assumption. So what they have taken as an assumption in the solution, they have not mentioned anything, but by looking at the question, you can figure out that this is on 1st of January, because loan, 1st of January date is given here. 68.5 is the loan. 31st March, it is 69.5, means we have to pay 1 rupee extra. So how much is this? 5 lakhs multiplied by 1. You have an exchange loss of 5 lakhs. Then when it was repaid at 70, exchange loss of another 2,50,000. You are required to pass entries in the books as per AS11. Okay, so your interest is not involved. You just need to calculate the exchange difference. Now, what is possible? First assumption is that the entity has not opted for 46A. You will debit it to P&L. Second assumption, entity has opted for 46A. Then you will add it to the cost of the depreciable asset. Okay, so that is how you will have to write the answer. Simple. Bank account restatement, whatever we have, first entry is for borrowing, second entry is for restatement, third entry is for settlement of the account. But here, please note, they have not passed an entry for transferring it to P&L. That also needs to be included. So this on 31st March, this restatement of 5 lakhs should be transferred to P&L as well. So you have to write that entry. They have not given, but you have to write that entry. Here, foreign exchange difference account at the end of the financial year, that has to be transferred to the P&L account. Okay. Deferred tax is not a part of our group 1 right now. So again, this question number 4 is also not a part of our accounts. Okay. Indigo loan mock tests are available as a part of your course. Okay, so you can consider that. I think we have covered some questions. We have seen some approaches to attempt these questions. Practice. Be very thorough with your concepts. By revising, at least I'll tell you, last 4-5 years, 4-5 attempt question papers related to accounting standards and the document that I've given, you will be in a good position to answer the accounting standards related question in the upcoming examination. Okay. I hope the revision was useful to you guys. And if you liked it, you can come back. The first part is available on YouTube. This part is also available on YouTube. Okay, if you want to download the notes, it is available here under CA Inter Paper 1 Accounting. No, sorry, not here. Under the notes section, you can download it from here. Here is where I have put this particular summary notes. You can download this and you can access this. Any more questions? You can feel free to use the forums that we have. Right. All the best for your exams. We'll see you soon again with another revision session.